Alrighty, everyone, hard money, here we go.
Let's go.
All right, everyone. So if you this is we're on our 4th year of hard money. If you're back, welcome back. If you're new here, Tom's going to tell you what hard money is all about.
Yeah, so 4 years. And so, the premise of hard money from the start was that there's a big tent here for hard money. It's gold, silver, and Bitcoin, the new cousin. But through the years, we've had phenomenal discussions with some of the greatest strategists across the spectrum. And also, we bring a diversity of companies to help you understand what it's like to dig these commodities out of the ground, and that's really where you get the beta, you get the leverage to the underlying hard money commodity. So it's been a great journey. We got a great set of companies joining us today. Scott, take it away.
Yeah. So first of all, we got to thank our partners. We got Kinross Gold, the Blokland Smart Asset Fund, Goehring and Rozencwajg, and the Godel Financial Terminal. So thank them. Wouldn't be able to do this without them. And I'm going to take you through who our speakers you're going to hear from are. We have Cambria Gold, West Point Gold, Silver VIPR, Cerrado Gold, Summit Royalties, Newcore Gold, and Heliostar Metals. So without further ado, let's ramp up hard money. Here we go.
Grizzle Hard Money, it is an absolute pleasure to have Kinross Gold, David Shaver. Thank you so much for joining us, the Grizzle Hard Money Conference.
Thanks very much for having me. I'm delighted to be on the show and look forward to it.
Wonderful. And so we had a chance to sit down in Zurich for a gold conference, and we're very excited to have you join our event. So David, I think something just to frame it up, Kinross has been a company that has been in the gold sector for a very long time. You've seen the evolution of the gold mining industry over decades, right? How do you
Yes.
think the business has changed from an operating and financial perspective? Like, talk us through just the differences that have evolved over the last several decades.
Yeah, certainly. I've been through a few cycles very close to the industry, but I think it's evolved quite a bit from my perspective. I think if you go back a number of years to the last couple cycles, it was all about production growth, growth, with maybe less of a focus on returns and costs. So I think we've evolved from being growth focused to more focused on IRRs and returning capital to shareholders and being more shareholder friendly. But if you go back, 10 or 15 years, lots of growth. This was lots of M&A. It was all paid for with a lot of debt put on by the gold miners. This didn't really result in outpaced returns for the shareholders. The companies got their balance sheets too stretched. They had to sell assets. They had to do dilutive equity raises. And then this cycle, we've seen, the balance sheets getting much stronger from cash flow. Now, I think there's a real focus on return on invested capital, internal rates of return, and then also increasing dividends and share buybacks. So I think more recently, there's a lot of cash flow generated. It's going into right now, I think, both some production growth, but also making sure shareholders are sharing and getting capital back. But a lot more discipline this go round in terms of shareholder friendly initiatives like dividends and buybacks than it's been in the past.
That's a great overview, right? But it is really so different than it was in past cycles, and we're flirting with 5,000, and that I think is one of the key parts here is that we're flirting with all-time highs, 4,500, 5,000. But from a excitement perspective at the corporate level, it doesn't feel like the industry is like popping bottles. It does feel like there is, there's prudence, if you will. And maybe, just your thoughts around that, and how is the industry as a whole internalizing these high these high gold prices as you think about capital allocation, investment. Obviously, you gave a great backdrop of some of the good times that and the excesses they were of the past. But are you guys acting like it's $2,000 gold? Like, give us some of the window into how a gold company's thinking about it right now.
Yeah, no, definitely. Great question. I think gold prices have run up pretty quickly, and I think most gold producers, including Kinross, are being, quite conservative in their gold price forecasts, both for calculating reserves, but also when we're looking at M&A and capital budgeting. For example, we used $2,000 and $2,500 to calculate our reserves and resources, respectively. So, over the long term, we're still thinking or trying to make sure our businesses will run profitably at much lower gold price. But for the short term and for 2026, we ran our guidance numbers at a $4,500 gold price, so much closer to spot price, and that's more in line with the with the rest of the senior gold producers. So I think over the short term, we're okay to creep our gold price up, but we're not going to make long-term investments at prices that are anywhere near spot at this time. When we do look at investments, we always use a range of gold prices and want to make sure our investments have strong IRRs, double-digit IRRs at much lower gold prices, as well as operating costs that are well below spot. So we want to make sure we're focused if gold price ever does drop, that we still have strong returns and are able to generate positive free cash flow. And for example, in January of this year, we announced that we are reinvesting $1.5 billion into 3 of our U.S. assets to extend life. These investments had very attractive IRRs, even at $3,200 in the 20 to 32 range, $3,200 gold. But at pricing in the current area of 4,500, it's more about around in the 60% IRR. So we always plan for more conservative gold prices, but we're pleased to take higher returns generated at today's spot prices. So I don't think most miners are operating their businesses as if it's a $5,000 gold price, but we're looking across our portfolio for opportunities to reinvest and extend mine life and generate these strong returns for our shareholders.
It's David. Yeah, great. Great perspective there, and with respect to how gold companies are thinking about it. And I think one of the interesting aspects that have turned in the market is that some of the excesses of the past led to gold miners underperforming physical gold, and that was an interesting time where people are like, just invest in the gold, just invest in the gold bar. These these miners, they're not the greatest capital stewards. Clearly everything you've described there is taking a total different take on capital stewardship, and that's come through in these gold miners outperforming gold. Maybe you could talk about are we seeing a broader investor base that may have left gold miners in the past come back in? Where are we in that? Because it feels like we're still early in terms of the broader investment world, not specialists looking at gold miners particularly.
Yeah, no, that's a great question. And yeah, we are definitely seeing, I'd say more generalist investors come into our shareholder register. And we've done significantly more investor marketing over the past couple years. I'd literally have been around the world over the past year meeting investors, and a lot of them are new investors. And what we hear from a lot of the generalist or new investors is they're really attracted by metrics like a free cash flow yield, that for a company like Kinross is in the 10% range at today's price and street consensus free cash flow yields or forecasts. So that really screens well when a generalist money manager is looking across the sector. There's really attractive valuation metrics for the gold industry and Kinross in particular. And one of the places we're seeing in the large money management firms, many large money managers who are our shareholders, they run multiple funds and they're run by different portfolio managers. And what we're seeing is the generalist portfolio manager reaching out to the gold specialty portfolio manager or the resource portfolio manager who's seen the strong returns and share price in the gold sector and asking for who are your favorite companies in the gold sector that we could put into our our generalist portfolio. So definitely we're seeing more come in through our existing shareholders by adding it to other funds, but also more broadly we're seeing many more pension funds, sovereign wealth funds, people that don't really run specialist money coming into our stock. And they are attracted by, I think, predominantly this really strong 10% free cash flow yield. So definitely a growing investor base. There's more to go. I think we're still early days in generalists investing in the gold sector, but it's got the right trend, and we're doing everything we can to meet with investors to tell them the story of the gold sector and Kinross.
Yeah, you just saying, double-digit free cash flow yield. I can't think of a time in history where adding a gold company would enhance your portfolio free cash flow yield. Like a special time indeed, right? That's
Absolutely.
So, and maybe just on that point, obviously free cash flow yield, but what are the key financial and operating metrics that Kinross focuses on to maintain a leadership position among senior gold miners? Right, obviously free cash flow yield, a clear attraction point. Maybe you could highlight in aspects that investors should look at for knowing success within the company.
Yeah, I mean, with this, in this rising gold price environment, we've remained laser focused on our cost profile. That includes our cash cost per ounce and our all-in sustaining cost per ounce. And if you look at our 2026 cost guidance, we're now at the lower end of the cost profile of our senior gold producers. We're not the lowest, but we're definitely at the lower end of the cost profile. So we've been really focused on cost and then also delivering on our production cost and capital guidance, where we have an excellent track record over the past 15 years of hitting our numbers relative to peers. When we give guidance, we want to make sure that we hit it, and that's really important. And what that cost focus has really allowed us to do is deliver growing margins and margins that have outpaced the rise in the gold price. And then this has resulted in record free cash flow for us and many in the gold sector. And with the cash flow, we've strengthened our balance sheet, and we remain focused on maintaining investment grade balance sheet, which is now in a net cash position of over $1.4 billion as of our first quarter results. And with all this free cash flow, we are now focused on returning capital to shareholders via buybacks and dividends. And in 2025, we reduced our share count by 3%. So we're really focused on driving better per share metrics, including cash flow per share and NAV per share. We're also focused when we're investing in our business that we're generating strong IRRs and short paybacks when we're making these type of investment decisions. So those are some of the metrics that we've been focused on.
Fantastic.
Right.
And David, maybe just for those who don't know Kinross, you could give us a little overview of the key mines for the company and key growth initiatives. New mines coming on. If you could give us a whirlwind around the company, that'd be great.
Yeah, sure. So we're a 2 million ounce. We're a stable. We've been producing about 2 million ounces of gold per year. Our 2026 production cost guidance is $1,360 an ounce on a cash cost basis, and on an all-in sustaining cost, when you include capital, that's $1,720 an ounce. So you can just see really strong margins relative to the current gold price. We've got global operations. Our two largest mines are Tasiast and Paracatu that extend into the next decade. Tasiast is in Mauritania in West Africa. It generates about it'll expected to produce a little over 500,000 ounces at $1,050 cash cost. When we move over to Brazil, we've got our Paracatu mine. Again, another world-class mine, 600,000 ounces expected this year at $1,240 of cash cost. And this is the 8th consecutive year we've done over 500,000 ounces at Paracatu in Brazil. Then we move down to Chile. We've got our La Coipa mine. It's expected to produce a little over 200,000 ounces at $1,320 cash costs. So that's basically 2/3 of our production, or 1.3 million ounces of production at cash costs of average $1,200. Then we move into the US, where we have 2 mines in Nevada, Round Mountain and Bald Mountain, plus Fort Knox in Alaska. These are all great jurisdictions for gold mining, and the 3 of those mines are expected to produce just under 700,000 ounces, at a slightly higher cost of $1,700 an ounce cash costs. And then, we've got a great project pipeline coming up. We recently announced extensions in the U.S. at Bald Mountain and Round Mountain, and the restart of our Curlew mine in Washington State starting in 2028. Which combined will deliver over 3 million ounces of production into the late 2030s. But what we're most excited about is our world-class Great Bear project in Ontario, Canada, that we acquired a little over 3 years ago. This project's expected to come online in late 2029, and annual production will be approximately 500,000 ounces at a very low all-in sustaining cost of $865 an ounce in our as per our preliminary economic assessment. Following Great Bear, we've got a project in Chile called Lobo Marte. Again, coming online in the early 30s, it is expected to produce 300,000 to 400,000 ounces at an all-in sustaining cost of $1,000 an ounce. So bringing in these 2 projects will bring in, 800,000 ounces of production a year at a cost profile that is significantly lower than our current cost profile in today's dollars. And then as we go further down into the portfolio, we do have an additional 27 million ounces of resources plus an incremental 17 of inferred, calculated at a $2,500 gold price. And this is in addition to the 21 million ounces of proven and probable resources. And right now we're going all across this resource inventory and looking for opportunities to extend production. And, some of those opportunities that we're reviewing right now, up at Fort Knox, we're looking at another extension called Phase 11. We have more pits at our Bald Mountain property. And Paracatu, we're looking at an additional layback. And at Tasiast, we're looking at the going underground as well as other satellite pits. So lots of opportunity in this gold price with to convert the resource inventory into reserves to keep these mines going well into the 30s. And then I think you also might have asked about geopolitical risk.
Yeah.
We're a global company. We search globally, but we are biased to the Americas and lower risk jurisdictions. And, you will have noticed we have exited both Russia and Ghana over the past couple of years, and our focus has shifted to the Americas region. So I would say we are Americas biased and biased to lower risk jurisdictions right now.
Great. And I guess just on that point as well, do you think the market is differentiating? Like, I think there probably is still a lot of opportunity there in terms of like that geopolitical risk, the fact that you guys have a lower profile. It's one of those funny things that the market doesn't quite appreciate until until something happens. But preparing for that and having the right geopolitical mix is critical.
Yeah, no, definitely. And we've noticed that our 2 things we've done is we've shifted our business to the Americas by acquiring Great Bear and reinvesting in the U.S. I think that's been noticed by investors, and I think we've also brought down our relative cost profile. I think that's also been really well received by investors as we continue, with those 2 strategies: cost reduction and the shift of our business into the Americas. So it's gone, I think, very well. It's been well received by our shareholder base.
Yeah, for sure. And David, just, final question, putting it all together, given that you have a 10% free cash flow yield, it's so you're gonna get investors saying, hey, this is this is a free cash flow, juggernaut. How do you think about capital deployment and opportunities like a Great Bear, and obviously putting capital into the ground? This is a chunky business, right? This isn't like you're not a widget factory, right? And so, and then at the same time, me as an investor, I still want to see that free cash flow yield. Like, how do you balance all that? And also buybacks as well, all buybacks, dividends, give us the kind of recipe of delicately balancing capital deployment with the metrics I want to see as an investor.
Yeah, no, it's a great question. And we've had a pretty simple and clear, transparent message around capital allocation for many years. And where that capital goes has been following that strategy. And our first priority, and those three components are reinvesting in our business, both in growth and sustaining capital, maintaining financial strength. That's by, making sure we have a solid balance sheet. And then the third priority in our capital allocation is returning capital to our shareholders through dividends and buybacks. So our first focus, reinvesting in the business, is we have to meet the needs of our business. And our philosophy is a well-maintained business is a low-risk business that can meet its guidance and cost projections. So that's kind of job one. And one of the things we did to reinvest in our business earlier this year, we have capital guided of $1.5 billion for 2026. And that includes the approval of the 3 U.S. projects where we chose to reinvest an additional $350 million over capital to what was in our prior plans last year. And we felt that allocation of that excess capital, that generated those returns, those 60% IRRs at today's gold prices. We felt that was a really smart place to reinvest a little more capital in the business to sustain mine life out into the 30s. So that was one place where we chose to reinvest. And then, in terms of the balance sheet, from 2023 to 2025, our focus was really on debt reduction. And we've been able to basically delever the balance sheet. So we're now have $2.2 billion in cash and $1.4 billion in net cash when you back out the debt. And given the significant resource inventory that we have, that 27 million ounces of measured indicated and additional 17 million ounces of gold inferred ounces, we see there's opportunity to reinvest in our business. So we want to keep some powder on the balance sheet as we continue to study these projects for mine life extensions into the 30s. And then, the last chapter, returning capital, we did announce this year we're targeting to return 40% of our free cash flow to shareholders, both via a sustainable, long-standing base dividend and share buybacks. And right now, when we look at our total return of capital, dividends and buybacks, that represents about a 4% yield. So the dividend we see as sustainable, something that we want to have for the long term. We've upped the dividend by 30% year over year, and are spending about $200 million a year on the dividend. So we expect that to remain really stable. When we move to buybacks, in 25, we bought back about $600 million in shares, or about 3.5% or 3% of our shares outstanding. And for this year to date, we've also bought back year to date this year about 300 million in shares. And looking at since Q1 of 25, we repurchased about $900 million of shares, and as I said, over 3% of our share count. So we want to continue with the buyback, and really what our objective is why buybacks. It's really improving the per share metrics, and we believe, at this free cash flow yield and our attractive price to net asset value, that this is a really good place to put our money right now. So we are a bit biased towards buybacks over dividends at this time.
David, that was a fantastic overview of of a business that's firing on all cylinders. Can't thank you enough for joining the Grizzle Hard Money conference.
You're welcome. Thank you very much for having me, and good luck with the rest of the conference.
Appreciate it, and look forward to having you back, David. That's David Shaver, Kinross Gold. Thank you so much, David.
Thanks, David.
Thank you.
All right, everyone. Grizzle Hard Money. We're going to take a quick break. We'll be right back. Don't go anywhere. All right, everyone. Welcome back to Hard Money. Our guest has been a big proponent of hard money for a long time, so much so he built a fund around it, and his shareholders have been benefiting now. We're excited to have him back. It's Jeroen Blokland of the Blokland Fund. Thanks for being back with us on Hard Money.
Yes. Oh, great to be back.
Jeroen, great to have you. You're an original. You're original. Yeah, almost the hard money concept was about the Big Ten, and actually, there's very few people who genuinely believe in the Big Ten other than you.
Yeah. That's right. Yeah.
Like finding gold guys and trying to bring them over, but no, it's fantastic. It's great to have you.
Okay, cool.
So, Jeroen, a lot has happened. I wanted to kind of start things off with Bitcoin. So, a lot has happened in the world of Bitcoin since we last had you on Hard Money. The big question for you is, has the recent underperformance and pretty much opposite price performance versus gold in the face of geopolitics and the looming risk of quantum computing, has that changed your view on Bitcoin at all and how it fits into your portfolio?
No, not really. So it's a good question, but first of all, we like gold and Bitcoin. So if one goes up and the other doesn't follow, and then it's the other way around, that's fine, as long as they go up over time against fiat currencies, dollars, euros, and bonds. Then we are fine, and we understand that there are always waves of that happening. I think that the case with Bitcoin is it has been a while that there has been a specific Bitcoin related catalyst, so to say, to push Bitcoin higher. So we had strategic Bitcoin reserves, we had Bitcoin ETFs, things like that, very Bitcoin centered. And for the last months or even quarters, you see, even though gold is down quite a bit now, but still over the last couple of years, gold has been a major story. Everybody is looking at AI stocks, what is happening. So I can imagine if you don't have a big story surrounding you, that you get overwhelmed by these other market driving themes. So I think that is one thing. On the quantum computer side, I read quite a bit on that, and you see the Bitcoin community is already thinking about a solution. I also think there is a solution with a relatively simple software update. Of course, I say it too easy, but I think the Bitcoin community in that sense is way ahead of other data sensitive platforms, databases, warehouses, government websites, you name it. So I think this is a general problem that will be solved. And contrary to other disciplines, it seems that the Bitcoin community is at least thinking about how this solution should look like. So I'm not that worried at that point. There's one other thing I would,
and maybe just a point on that, right? Like, I think you raised a really great point. It's like, if we do get to that point, other financial institutions are at risk. Like, it's not just your Bitcoin that's at risk; it's your money in your bank, and that's
your privacy details. Yeah. No, I think that at some point when quantum computing becomes an imminent threat, I don't think that is the case now, then you will see that forces or people or from all disciplines will in some ways work together to find a solution, because as you mentioned, it's not a Bitcoin specific problem. It's a societal issue, and you mentioned, but I also think a lot about privacy data, healthcare data. So at some point we have to figure out what to do with that, but we still have quite some time. There is one other thing about Bitcoin that is not making the headlines enough, I think, that I find very interesting, is Bitcoin-backed loans, Bitcoin-backed lending. It's a major new part of the infrastructure. It's going at warp speed. First of all, that tells me one thing, that in the whole world of finance, nearly every major asset class, you can deposit it as a collateral and then loan against that. And some that's a lot of money and some that's a little bit less. But that is how the financial markets to extent work. You can use assets as collateral. Now, you can now use Bitcoin as collateral. You can get up to 30, 40, in some cases, even 50% a loan backed by that. So first of all, that says something about the evolvement into a mature asset class. And the second part, and I find that the most interesting part, how can you then still argue that Bitcoin has no value? I can literally get US dollars by posting Bitcoin as a collateral and then put it in a money market fund. So the whole idea, it has no intrinsic value and it has no cash flows. I think it was already outdated, but with this whole Bitcoin-backed lending infrastructure, I think it's really, really outdated. So I find that very interesting. And you don't see that many people outside of the Bitcoin space talking about that. But for me, that is a big thing, let's so to say.
Great.
Great update.
And then maybe, just tying also into your thoughts, big picture on gold, obviously, we've just had Kinross on and it's been a fantastic, as you said, long-term market. Maybe you could get your high level thoughts on gold, near term and, the broader structural picture, obviously in the backdrop of a war as well and fiscal situation still deteriorating.
Yeah, it's interesting to see how gold behaves since the war on Iran started, of course. So we are back to the old narrative of higher inflation is higher interest rates is meaning that a non-cash flow asset is less attractive. Of course, interest rates are now somewhat higher. They're not extreme levels, especially when you take the amount of debt in the world into account. But I would say, if you see what has happened, will this make a country like China want to move away more or less from the US dollar? If your answer is more, then you also know how they must do that. The only instrument they have is through gold, because they have to buy trust in their currency to be able to distribute it across the world, because it does not have a world currency reserve status. Also, are geopolitical tensions again becoming structurally higher after this episode in the Middle East? So unless you think that the reaction function of gold in the long run has evaporated, then I would say gold is a pretty decent play to at least have in your portfolio for the longer run to protect against these specific risk or trends. Yeah, gold is down 20% from its high now. That's, of course, if you invest in gold, not a great thing. But the long-term thesis, I would say, has become even stronger than before this war or the conflict in the Middle East.
Great. Now, Jeroen, you've recently published a book, The Great Rebalancing. It's about scarce assets. I feel you've talked so eloquently in the past with us about it, and for viewers and readers who follow Grizzle. The book is out; it's available everywhere. Maybe you can talk about the key themes you cover in the book, because you get more detailed around your core philosophy, right?
Yeah, it's basically all about the philosophy and trying to understand it. So the book is called The Great Rebalancing. I will explain in a minute why it has that title. You can buy it on Amazon and all major bookstores. And basically, the book has two parts. The first is the problem. So a lot of people like to talk about problems, but the second part is about the solution. And these, in the end, are scarce assets. The problem is pretty straightforward. So we live in aging societies, and the big thing with aging societies, they grow less. Their ability to generate GDP growth goes down because people don't work or work less or slower and so on. So that basically means if you don't do anything, the standard of living becomes pressured because there are also many more people. Now, we don't want to accept that. There's not a politician that gets voted by saying, let's shrink a couple of percentage points. So we have this magic ingredient that is called debt. And with that, we artificially prop up GDP growth. Now, there are lots of charts in the book that show that this is actually the case. But then the real problem is that if you acknowledge that we are living in a debt-driven society or economy, then the rules of the game change. Because if debt is your main source of GDP growth or living standards or whatever you want to call it, then debt sustainability is the ultimate goal. It's the only goal that matters for policymakers, for governments, but also for central banks. Now, this, for example, explains I write a lot about this in the Netherlands, but it's a trend in Europe and I guess in the United States or Americas everywhere. And so taxes are going up. Yeah, this is because if you run a large budget deficit, you have to do something. So there is a trend when you want to finance GDP growth with debt, you have to raise taxes, right? The second is, of course, if you have a lot of debt, you need low interest rates. And this is where central banks come in. Central banks at some point will be forced, and we have seen that many, many times in the book. There's this part about central bank bingo. I go to all the different buying programs, negative interest rates, yield curve control, all of the things that have nothing to do with price stability. But there's interest rates must come down, and central banks are the main instrument to do that. And in the end, you end up with higher taxes, higher inflation, and lower interest rates. So this is a problem because lower interest rates and higher inflation is, of course, the death of purchasing power. That is the problem. In a debt-driven economy, purchasing power is declining. Now, that is the problem. And then we go over to the solution, and it's pretty straightforward, and we have discussed it for a couple of times. If inflation is abundant, if debt is abundant, if money is abundant, you invest in the exact opposite. Everything that is scarce, and you store your wealth. You can call it investing, but you store your well-earned wealth into things that are scarce. And for us, that is quality stocks, stocks of companies that are special or scarce, physical gold, and Bitcoin. And that is why we built a fund around it. And then why is it called the Great Rebalancing? If you look at traditional investment portfolios, none of what I'm saying about this whole fiscal dominance, low interest rates, high inflation is reflected in the strategic mixes of that portfolio. Yes, they have equities, but not special equities, so to say. But more importantly, they have cash and they have bonds. And you will see that if people start to understand that fiscal dominance is the only outcome when your society is aging, then this whole massive transition of existing portfolios still has to take place. And this is why I call it the Great Rebalancing. Every year, every month, some asset manager, some pension fund, some guy or girl will say, okay, this is not how it works in the future. The final part is also to accelerate that Great Rebalancing. We will see a couple of things happening. First, there will be another debt crisis, and central banks will be forced to solve it. Second, as we discussed with relation to gold, China will increase its efforts to move away from the dollar. And third, we are looking at the biggest wealth transition in history, meaning billions or even trillions of money and wealth will go from older generations to newer generations, and newer generations look totally different at how a future-proof portfolio should look like compared to baby boomers that were raised with 6% interest rates and even higher on their bonds, of course, and no inflation. So the first part is the problem. Lots of charts showing the problem, but then also a very clear, concise solution, which is scarce assets. And this is also why I'm in your show. Call it hard assets, call it hard money, whatever. But you end up with the same trajectory. And I expect more and more investors, people to acknowledge this and actually do something about that.
That's a great
excellent
summary of a thesis. And for those viewers, we've got the link. We'll have the link in the description, available at
Perfect.
Amazon, everywhere, and also and those reading our Substack, the link will be there when you're reading this as well.
Okay.
But
Thanks.
that's fantastic to know that you put this out in a great book. Thank you.
Yep.
All right, I want to talk about inflation a little bit because there's this great chart that we had our hard money 2 years ago. You had that chart, you've been updating it, and it's very intriguing. It's just looking at inflation in the 70s versus what's happening now, and there's a lot of similarities that are happening again. Could you just talk about the current crisis in Iran? Is that the Kickstarter to lead to a new uptick in inflation? You know, you can say that these charts, you can put charts on charts, but I'm wondering, I'd love your take on what do you think are the catalysts that really will drive this next leg of inflation if we do get that? Is it
Yeah.
oil? Is it commodities? Is it something else?
Now, what makes this chart, of course, interesting is that a lot of players involved in the inflation spikes in the 1970s are also the players that are involved with what is happening now in the Middle East. So it surely rhymes, as it say. And what is interesting, if you just updated the chart, we now had this mini spike in US inflation exactly at the same moment if you cross over these two charts, and that of course is why this chart is now making headlines, because the moment it started accelerating again, because it's the second peak, it also seems to be starting now, and of course that has a lot to do with oil. It also means if announces a structural peace deal tomorrow, we won't get to 10% inflation in the United States or anywhere else. But having said that, before that, before the Iran war started, there were also signs that inflation risks were elevated. Let's put it this way. The first is money supply growth. Money supply growth is at 11% analyzed pace. So it has been 7% since the great financial crisis. And even from that level, people say that's quite impressive. Now, this is extraordinary impressive, 11%. And this has to do with this whole refinance or existing debt. But 11%, there are libraries full of evidence that money supply growth used to be the official definition of inflation, and it will lead to higher prices, because that's, I think, the best way to say it. So as long as money supply growth keeps growing at that pace, inflation risks are higher than average. The second thing is that if you look at where interest rates are now, and suppose that they stay here for next couple of years, then you will see that interest expenses as a percentage of GDP will spike around the globe. For the United States, from 3 to 6%, from France, from 1% to 5%, in Japan, from 1% to 10% of GDP. Now imagine what that will do with budget deficits. It's really unsustainable when your only goal, which we talked about, is debt sustainability. It's simply not allowed to let interest rates come down. Now, of course, a couple of things can happen. If you get a crisis, this will be the best for central banks, because they can shield behind this crisis and say, it's a crisis, we have to lower interest rates. Okay, that's fine. But if that does not happen, then they have to show their cards. Are we about inflation targeting, or are we about debt sustainability targeting? Either way, when interest rates are coming down again, or central banks are forced to pull them down again, this also brings inflation risk. So even without the Iran war, there are inflation risks that are considerably higher than average. Does that bring the US inflation rate to 10%? I don't think so. But will it be above 2%, way above 2% for way, way longer? Yes, I truly believe that is the case. Then the second part, if I may, everybody looks at this chart and then nothing follows. So what should I as an investor do with that then? So I looked at some numbers. In the 1970s, we had two inflationary spikes. What happened to gold, bonds, and equities? Now there's a big difference. Gold in real terms. So in real terms, after inflation, because inflation was high, it rose 283% during the first crisis and 285% in real terms during the second crisis. So that's massive run up in the prices of gold. Equities went down the drain. Bonds went also down the drain. It's not a safe asset when inflation is involved. They went down 11% in real terms and 17% in real terms. So if you believe, and that is my point, if everybody is staring at the same chart, fine by me. I like to look at it, well, what is going to happen, but then also adjust your portfolio accordingly if you believe this is going to happen. So if you don't have any gold, that would be a bad idea, in my opinion. If you believe this is going to repeat, okay, then also do what happened then, and at least add some gold or add your first gold, depending on which portfolio you are running. And the mainstream media like the charts, but not the conclusions, or they do not discuss the conclusions. Well, I do it for you. That's fine.
Great. And so obviously you've run a fund on this thesis. Could you just talk about the high level strategy right now and how you're positioned? Final
And how people can learn more about the
yeah
fund too.
yeah
Yeah. Okay. Now, first, to answer that last question, we have a website, bloklandfund.com. It cannot be easier. Blokland, and then from there you can go. We also have a Substack. So if you have Blokland Fund Substack, you will also find us in English and Dutch. And to come back to your first question, we have a strategic weight in gold of 25%. So a quarter of the portfolio is in gold. And of course, price movements can deviate a little bit from that. It can be 27, it can be 23. But always a large part of the portfolio will be in gold. We have a 10% strategic weight in Bitcoin. As the first question you asked me, it's not going to change anytime soon because I'm still bullish. At some points, we will see another run up and then gold, for example, does not perform. And we have just over half of the portfolio is these quality stocks, these scarce stocks that can do something that other stocks cannot. And of course, if you can calculate a little bit, that is not it's not a coincidence that this resembles a 60-40 portfolio, but then instead of 60 equities, 40 bonds, it's 60 equities, just a little less, and 40 scarce assets from, let's say, the non-traditional financial world. And that is our thesis translated into an actual investment vehicle. And of course, I am extremely convinced that in the end, this will perform way, way better than holding bonds or cash or anything closely related to that.
Excellent. That was a great overview.
Thank you so much.
All right, very quickly, I just want to hit on the fund has a unique aspect to it where you have an emergency brake that you use in certain scenarios.
Yeah.
Could you just tell us a little bit about the indicator? And I'm curious, was it tripped in April 2025 at the beginning of the Iran conflict?
Yeah, good question. Yeah, so the emergency brake is a instrument. It's a sentiment-driven indicator that has been well researched. That at some point, when market sentiment really goes down or goes bad, we neutralize the exposure to, for example, equities. So that is one thing. And the purpose of the emergency brake is very simple. If we get in a dot-com bubble that pops, if we get into a great financial crisis, if we get into a COVID, then at some point, we will also go down on the first leg downward, of course. But then the model has to say this is enough. And the reason, therefore, is simple. I've been doing this for quite a time. When people see their portfolio or part of their portfolio go down 30%, 40%, 50%, or in the .com even 60%, they start doing strange things. Their emotions take over. They get angry. They don't make the right decisions. And we want to help them with them. So for these great drawdowns or bear markets, there has to be a protection. Now, the other side, and that is to the second part of your question, is that also means that when equity goes down a bit, but not that much, sometimes the emergency brake is goes on, and sometimes it's not. In April, it went on, but it did not bring us anything in return. In fact, we went in back a little bit higher than we went out, and this is because the recovery has been stellar and things like that. But still, then, and that is what a lot of people. I want to talk about risk and not return, but the volatility of the overall portfolio, because we were out of equities, still is lower. So on a sharp risk return basis, you can still add value. But if you have a very shallow drawdown or a sharp drawdown, but then with a very a V-shaped recovery, so to say, this is not what the model is built for. We need a .com or an AI bubble to pop to show the true value of this emergency brake. I don't want that to happen, but then it has to show its value, not on these temporal 10%. And sometimes it goes off, and sometimes it does not go off, so that's noise for the long run.
Big thank you.
Thank you.
Can't thank you enough for a phenomenal overview and always being an anchor guest for the Hard Money Conference. Jeroen, for those who haven't, the link is in the description for the book and the Great Rebalancing. Jeroen, thank you so much.
Yes, Always great to join you guys. Nice.
Thank you.
Welcome back to Hard Money, everyone. The train keeps rolling. It's our pleasure to welcome Rob McLeod. He's CEO of Cambria Gold Mines. Rob, thanks for being with us.
Hey, boys. Great to be on.
You know what? And PDAC was special, and I'm happy we can continue the good times. It's Rob, thank you for joining us.
Wonderful to be on, and it's about time, man. I got lots to update you guys on. Some new
good.
stuff.
Let's
kick
do it.
into
Let's
Tom.
do it.
Yeah, let's kick it off.
Yeah. So, Rob, for those who don't know, could you provide a high-level overview of the Golden Triangle as a mining jurisdiction for precious metals? Obviously, your backyard.
Sure. So, located in Northwest BC, this is a very special part of the world when it comes to metal endowment. There's copper deposits. There's world-class gold and silver deposits. But what are really special about these is how rich they are. Like Eskay Creek, for example, richest mine globally in the modern context. The Bruce Jack mine, which is operated by Newmont, spectacular grade in spots. It's super nuggety, but an amazing deposit. Seabridge's KSM, Newmont and Teck's Galore Creek, huge, massive copper gold deposits. And with us at Cambria Gold Mines, the Granddaddy Project, the Premier Mine, which was the richest mine in the world for 15 years, about 100 years ago, and something that we're going to be putting into production real soon.
So, Rob, could you just tell us the history of the Red Mountain Project? I know you know it really, really well. You have a long history with Red Mountain. Why does combining production with Red Mountain, with the mill and the ore from Premier, make sense for you guys?
Sure. So at Premier, we have, by underground standards, it's a good-sized mill. It's about 2,500 tons per day. And the challenge with, this mine failed last year and in 2024, two attempts to start up. And the challenge was they couldn't locate enough easily accessible ore proximal to their underground workings to be able to feed it. This type of mill, the rock grinds itself. So you need to have a steady state of production. Red Mountain, which, is my first geological job out of university, I worked on it. I actually sold the asset as part of IDM Mining to Ascot, the predecessor name for Cambria, back in 2019. Brought the project through feasibility study and through the environmental assessment process. This is a brilliant deposit. I think it's the best undeveloped gold deposit in Canada. For underground, it's a wide ore body and super high grade. There's a little under 800,000 ounces of measured and indicated, of which 544,000 ounces are measured at 8.8 grams per ton, and it's wide. The whole ore body averages 15 meters wide. It's up to 100 meters wide in places. And it's accessible. There's existing underground workings that were put in the 1990s. And we are going to truck the ore from Red Mountain 50 kilometers to this beautiful brand new mill at Premier and have a combined operation. So we're targeting, and it'll all come out into a feasibility study, but sort of the range that we're targeting is in around 150,000 ounces per year, with probably about 75% of the resources coming from Red Mountain, and then about 25% from these high grade and potentially bulk mineable deposits around Premier. And so we'll have a real nice sustainable operation, mining all these different deposits with the one mill. And it's also scalable too. There's lots of other nearby deposits that potentially the ore could go through as well in the future.
And so some exciting news. So we've heard some rumblings from your copper mine, Mount Margaret, previously buried inside at the Ascot business. You're planning to spin that out to shareholders. Tell us more about the asset, the potential, and your plans for it.
Sure. So, many junior companies have had different iterations, and like 4 management teams ago, before Ascot Resources acquired the Premier Mine, is there was an asset deposit in Washington State that they had picked up. remarkable history behind it. It was discovered in the 1970s. A company called Duval Mining put in 105 drill holes. In 1980, they came up with an initial resource estimate. So this is pre 43-101, so you shouldn't rely on it. So it's just an indication of the historical endowment. But is 577 million tons at 0.72% copper equivalent. It's mostly copper and gold, but also some silver and molybdenum as well, starting at surface and wide open for expansion. Now, the location of it, it's in Washington State. It's located near a volcano that erupted in 1980 that you probably heard of, Mount St. Helens. When Mount St. Helens erupted, that halted the work on the project, and there wasn't any more work that was done until 2010. In that time, Ascot drilled 10 holes totaling 5,000 meters. Every single hole ended in mineralization. And so that doubled the down dip extent of that historic 577 million ton resource. By the way, the cutoff of that resource was 0.3. So the limits along strike and across strike for this deposit haven't been found to depth. And here's the kicker. This deposit is owned by the federal government of the United States, the BLM. And so, as you know, the United States is very interested in domestic critical minerals production. There's no more critical mineral out there than copper. Most of America's copper is imported. This is a unicorn project. There hasn't been a mine built like this in the United States in 50 years. It's really, really special. And so we're going to be spinning that out. Look for some announcements in the weeks ahead of the process. We're going to put together a new management team. The company is going to be U.S. domiciled. The intent is to list it on the American exchange, probably the NYSE, and Cambria Gold shareholders. It's our intent that they would own 49.9% of the spin-out company.
Okay, great. That's very exciting, and it's obviously great timing as well. The AI does not run without copper.
No, it's where, we're at all-time highs for the price of copper, and the demand is just there. You guys know this. There isn't the supply out there. There's, as I said, there hasn't been a copper mine built like this in the U.S. in 50 years. And so,
it takes decades to find a new one.
Yeah, and there hasn't been enough new discoveries out there. And especially, this isn't deep. There's new discoveries that are, miles down. This outcrops. There's about a kilometer of outcropping, square kilometer of outcropping mineralization. It is truly remarkable.
Well, that's a nice surprise for shareholders. All right, we'll look to get more details out of that for sure.
Yeah. Yeah, it's remarkable. Always look in your back office. You never know what else might be found in there, man. So
there we go. Now, I just want to have a high-level question for you. How important is exploration at this point to the Cambria story, would you say? Or is your focus really on definition drilling and converting all these ounces at Red Mountain from inferred to reserves? Like, how should we think about this split?
So I'm a big believer in the exploration potential at both the Premier and Red Mountain deposit. However, it's not going to be a focus until we're pouring gold. So what we do need to do is infill drill, and particularly at the Premier area deposits. I've seen this in quite a few other different failed projects mines, is that you don't drill enough definition on these veins. Veins are never straight and tabular. They can often be folded around or faulted. And so, particularly for any of your listeners that invest in the space, if there's a development stage project, see how much measured resources they have, particularly for an underground deposit, because that means it's been fully defined. Red Mountain actually does not need any drilling probably for 5 years because there's such a substantial measured resource endowment. It's been scissor drilled from both directions. It's been bulk sampled. It's wide, so there is no question about where the location of the mineralization is going to be when you go in and start stoping. And so at Premier, however, we have 3 drills that are going to better define those measured resources. When you update the feasibility study, measured gets translated into proven reserves, and those are the first areas that you would go and mine on a restart scenario.
I just wanted to move on, Rob, to talk about the. So you've laid out pretty clearly what the first phase is of your restart. I'll tee you up a little later to kind of walk through those different phases. But just wondering what the plan is for the second phase, how you think you might fund that. I mean, I looked. You guys have warrants where potentially those could fund a large portion of phase two. How are you thinking of how you'd like to fund phase two when you eventually get there in 12, 18 months?
So we got a really important piece of advice from our second largest shareholder, a portfolio manager named Steve Land with Franklin Templeton, the largest manager of money in the U.S. in the mining space. And his advice was like, look, warrants to many are considered like a sweetener in a financing. They shouldn't be viewed that way. They should be viewed as a financing mechanism. So with the private placement that we closed in January of 2026, the second tranche, there was a half warrant attached. If all of those warrants get exercised, that would bring in another $125 million Canadian. And so that, his advice was always stay fully capitalized. Those warrants expire, they're 1-year warrants, so they expire in December or of 2026 or January of 2027. So they're short term. We've already had a bunch of them that have come in and that are being exercised because the first tranche of the financing came free trading on May 1st. And so, we are optimistic with in addition to our very healthy treasury now, but getting in those additional warrants will help get us to production. Now, that said, there's a few different optionality things that we're looking at for the projects. Like, for example, Red Mountain, and this is something investors, you always got to tell the bad with the good. The Golden Triangle gets world record snowfalls. Like if you want to go to the Bruce Jack mine, you got to drive on a glacier. And so managing winter mining projects up there, how the old timers would do it with aerial tram lines. So we're looking at building an aerial tram line at Red Mountain. We anticipate the cost to be around $30 million. And so, if there's some of that, we're still working through the feasibility and what a restart plan would look like. So we don't have our final numbers, but you put it in a tram line, that'd be some additional capital. And maybe that's funded through some of this warrant exercise.
Man, that's profound. That's a smart way to think about warrants. I haven't heard that from a management team before. What about would you guys consider the gold-backed notes that I know West Red Lake used at one point? Is that something that would be an option for you guys?
So, hey, it's the mining business. You always might need more capital in the future.
Right.
So I'm never going to ever say, no, it's not a possibility, but it's our goal. We're not promising it, but I really hope that we don't have to dilute anymore. And, with this Mount Margaret spinout, Cambria is going to own 49.9 of the spinout company. So that has additional optionality. Cross out 10% of that ownership to get some cash if we need more. And so would we do a gold back note? Hey, the ones for West Red Lake, they trade so nice. They're a really nice piece of paper. It's our hope that we don't have to further burden this project in this company.
Got it. Yes, you're planning the restart to not have to tap that.
Yes.
Got it.
All right, final question. Rob, so can you walk us through the restart of the roadmap between both 2026 and longer term? What are the major milestones, and when are you currently planning for the mill to turn back on?
Right. And so the key to a successful operation is the development of Red Mountain. And we are starting the construction of the access road to Red Mountain imminently. And so that will be completed. We first hope to get, the first bit done this year and have it completed in 2027 to be in a position to start underground development and stoping and trucking ore. But that said, we are contemplating an earlier restart. I'm a student of mining history, and we are taking the approach at two of our deposits, Big Missouri and Silver Coin, to do what the previous operators did, which is bulk mining, and that can provide sufficient tons to this mill blended with high grade from the Premier mine to potentially have an early restart, maybe as soon as mid 2027. So no promises, but it looks really good like this would be feasible. And, so we can start cash flowing while the construction of the Red Mountain deposit is completed. Red Mountain's going to be the big profit driver. But I tell you right now, we're paying care and maintenance. And I'd sooner break even from a mining operation than pay care and maintenance costs. So we are doing those current trade-offs. And in the months ahead, we'll have some news on what our decision would be on that side.
Excellent. I love how you guys, you're not standing still. You're not like, we had a plan 12 months ago, we got to execute on it. You're always looking at how the market changes. And as you learn more about the asset, you're saying, well, maybe plan B makes sense. Maybe plan C makes sense. I don't usually hear that from management teams. So I appreciate it.
But yeah, Rob, big thank you. Obviously,
Thanks,
great to get the update, and you got something fabulous with on the copper side. So look forward to you staying in touch. We'll have more. Our big next big conference is Commodity 1-on-1. But Rob, thank you so much.
All right, everyone, welcome back to Grizzle Hard Money. It's our pleasure to welcome Derek Macpherson. He's CEO of West Point Gold. Derek, welcome to Hard Money.
Hey, guys. Thanks for having me.
Thank you.
So, Derek, for people who don't know West Point Gold, could you kind of just give us a high level of your asset portfolio and a quick history of the company and the management team?
Yeah, so West Point Gold's a Southwest U.S. gold explorer. All our assets are in Arizona, Nevada, all in a geologic formation called the Walker Lane Trend. Our flagship asset is our Gold Chain project, which is in Arizona, just across the Arizona-Nevada border. I've had some really good drill results there over the last year and a half or so, and have been really excited to be working towards a maiden resource there later this year.
Amazing. Now, I'm curious investors who don't know West Point, what is kind of your long-term strategy? Where do you want to be in 24 months? So is this a team that you take assets all the way to production? Is your expertise in exploration building a package that then a larger player wants to acquire? How should we think about your strategy?
Well, I think you gotta build the team for the project where it's at right now. And so right now our asset is more exploration stage. We're working towards that maiden resource, and so we're a geology heavy team, and maybe engineering light. As we get more in the development stage, we're gonna have to add those other skill sets. My view on selling it to somebody else or building it, you have to advance the project until someone else wants it more than you do. And so we got to keep de-risking the asset and moving it ahead. The first step of that process is, as I said before, is going to be that maiden resource later this year.
Okay. So you guys just completed a capital raise. You're fully funded for a pretty big drill program. Could you just walk us through the key targets and the timing and the size of the program, how many meters you're planning?
Yeah, so we're just wrapping up a 20,000 meter drill program. And so that puts us in really good shape financially for the next drill campaign as well. Where we've drilled, that drill campaign really had two objectives. The first was to deliver a maiden resource at the Tyrone main zone, down to 300 meters. And so we spent the last almost over half the drilling campaign just focused on that, drilling down to 300 meters. In fact, for your viewers, right now we have about 7,000 meters in the lab from that drill campaign. The majority of those meters are actually from the deeper holes at Tyrone main zone, where we've had a lot of exploration success this year. And so potentially some good news on the horizon, knock on wood, assuming that all goes as expected. The other half of that drill program, though, and the second objective, was to make a discovery at one of the step out targets. Gold Chain project's over 10,000 acres in total. We have probably half a dozen high quality targets out there. And so as part of that campaign, we actually have already announced discoveries at what we consider what we consider to be discoveries at Black Dyke and at Sheep Trail. And so what we consider to be a discovery is we have the potential to deliver a maiden resource. The one thing about our project is we've got lots of gold at surface all over the place. We've got lots of structure and historic mining as well. But we were able to drill enough holes at Black Dyke and Sheep Trail. We're probably onto a small resource in both those places already. And we got to follow those up, and expand them. We have another target where we're waiting on assays, which is Bull 8. And that one is really interesting. And the reason Bull 8 is really interesting is that Bull 8 is part on two major structures, the Frisco Mine Fault and the Union Pass Fault. And though Bull 8 is sort of the north west extension of those two structures. Further to the southeast, where those two structures are pulled apart, we have a target called the Frisco Graben. And while all of our targets are really good, and Tyro's going to be, and, has a potential to have an impressive resource on its own, the Frisco Graben is the big potential prize. It's 4 kilometer by 750 meter wide target. It's also a much higher risk because we don't get gold at surface there. It's a blind target, and so we want to get back. So we're trying to de-risk it by drilling around it. Some of that drilling at Tyro will get us there. This drilling at Bull 8 will get us there. We're doing some additional geophysics and hope to get back to drill that when we resume drilling in the next campaign.
So when are you thinking you might have some assays from the Frisco Graben where you're, we can start to evaluate what the opportunity could be?
Yeah, that's a great question. I'm probably not going to drill it till 2027. As of right now, so right now the drilling campaign is focused on converting the exploration target we have at the Tyro Main Zone. So Tyro Main Zone is 1 to 3 million ounces at 2 to 3 grams a ton at surface on patented claims, one of the best mining jurisdictions in the world. So a really attractive target. We're trying to convert that into a resource. That's going to really de-risk the company as overall for investors. And then we could take those high risk shots at the Frisco Graben after that. What we're going to see potentially for the areas around it, I think Bull 8 we'll see in the next month or so. We'll see some assays there, which is kind of that extension of the Frisco Graben, and then we'll get back to drilling. We're going to chase Tyro Main Zone intersects one of the major structures that control the Frisco Graben, so we're going to chase that in. I think though the potential of the while the Frisco Graben is this really big blue sky upside, my opinion, I'm the CEO, so I'm supposed to say this out loud, but my opinion is the company's undervalued already based on just on what we have at the Tyro Main Zone, and that main resource is really something that's going to be exciting for investors.
That's a really useful overview. Could we drill down on Tyro Vein a little bit? What are some of the drill results you've gotten, sampling data that makes you excited about the opportunity? You think there could be more there?
Yeah, so Tyro is a kilometer long target, kilometer long of outcrop. There was a little bit of historic mining in the 1980s. They didn't really know what they were doing. We started drilling it in 2021. We hit 2021, we hit 20 meters at 2 grams. In 2023, we hit 44 meters at 2 grams. In 2024, bad times for the mining market. You drill one hole a year, feels like. 89 meters at 1 gram with 36 meters at 2. Then things really started to get interesting. We drilled hole 34. That hole hit 42 meters at 2.5 grams from surface. But that hole hit an open stope. So stope from 100 years ago, the old timers weren't mining half a gram. They're probably mining 14 or 15, kind of half an ounce. And so we drilled underneath that with 47, 48, and 49. 49 hit 30 meters at 9 grams. And that was the first, kind of the first of what is half a dozen 200-gram meter holes that we have drilled into that northeast Tyro zone. And so what we're really putting together there is a 20 to 30 meter wide zone of some very good grade material. We've drilled it off over 400 meters in length. The deepest intercept there is 300 meters. That's released today. And we've got, as I said, the assays that are coming out are the deeper holes in that area. And so certainly good. That's not to discount sort of the southern portion where we hit that 44 meters at 2 grams or that 89 meters at 1 gram with 36 meters at 2. We're also expanding that to depth, and that's going to give you your bulk to fill out that exploration target that we're looking to convert to a maiden resource in late Q3, early Q4 this year.
That's great. Better understand that now. So I wanted to move along to your Jefferson Canyon option agreement with Kinross. That's interesting. Could you just talk about how that deal came about and what's the opportunity you see in the project overall?
The deal came about because I picked up the phone. Apparently, the prior
That's a great answer.
the prior operators wouldn't talk to Kinross, and I don't know why. That project is 7 kilometers from Round Mountain. So Round Mountain is 300,000 ounce a year mine for Kinross. It is towards the end of its life, and so they are looking for feed in the area. In fact, if you stand up on the project, there's a highlight intercept there, 41 meters at 6 grams gold and 400 grams silver. If you stand where that hole was collared, you can look down into the pit at Round Mountain. And so we picked up the phone, we started talking, we got to terms that made sense. The deal was done in 2022. We got to terms that the deal made sense. And the reality is with that option agreement, Kinross is keeping the property in good standing, which is good for us. They got to spend a little bit of money on exploration, but that's not what's going to be game changing here. There's 145 drill holes into Jefferson Canyon. So, but we have none of the physical evidence of that drilling. So they want to put a few holes in to make sure that what they think is there is there. Then if they want an interest in the project, rather than spending a bunch of money, which often these option agreements into the project, which doesn't really add value for West Point shareholders, they have to write us a check. So they want 70% interest in the project. It's a US $5 million check. To get the next 10%, it's another US $5 million. So, for US $10 million, they can have 80% of Jefferson Canyon. After they complete the exploration, they do not own any of the project, and they would have to go to the next step for that. So it's a deal that's good for West Point shareholders in the sense that we will get we'll get value out of it directly that either we can redirect towards more drilling at Gold Chain, or we can put back into the joint venture to maintain our 20% interest. But I think that's from my perspective, it's a well structured deal, and that's how Kinross got their interest in the company as well.
Gotcha. Yeah, so you're not forcing anything because you have a pretty long period where you can kind of take it slow. Is 4 years? Is that how it's set up?
Yeah, it is. It's 4 years for them to drill from when we get permits. The big challenge in Jefferson Canyon has always been permits. It is a U.S. Forest Service ground, and so while that in theory is getting easier, as with the current administration, still has been a challenge to get permits there. And thankfully, that's Kinross is dealing with that. They have more expertise than we do to get permitting done.
Right. Perfect. All right, maybe could you just round things out by walking us through the key catalysts that investors should watch for this year, the things that you're looking forward to figuring out about the property?
Yeah, so I think first and foremost is going to be drill results. We've got, as I said, roughly 7,000 meters of holes that are drilled that are unreleased, and waiting because we're waiting on the lab. And so now that's going to take us probably till mid-July. We'll have mid to late July based on the turnaround at the lab right now.
Okay.
And then the results of that program are going to culminate in the maiden resource. So, we're talking about late Q3, early Q4 for that maiden resource. That will just be on the Tyro main zone. And then in September, and then in September when things cool off at Gold Chain, we'll get back to drilling. And we'll be pretty aggressive again next year. The one, as you mentioned at the very beginning, we are well funded, and so we're funded for a sizable program at Gold Chain next year. And our operational year is September to May because of the weather down there, and so we're funded for a complete program September to May next year.
Yeah, so the next 12 months, you'll be able to do a lot of kind of delineating what you really have, and you'll have the main resource come out, so we'll know a lot more.
Absolutely, yeah.
Yeah, great. Well, Derek, thank you for stopping by Hard Money. That was Derek Macpherson, CEO of West Point Gold. Thanks a lot for being with us.
Thanks for having me, guys. Really appreciate it.
Thank you, Derek.
All right, Hard Money, we're not going anywhere. We're going to take a short break. We'll be right back. Don't go anywhere. All right, everyone, we're back. Grizzle Hard Money. It's our pleasure to be joined by Drew Clark. He's CEO of Summit Royalties. Drew, thanks for being with us.
Pleasure. Looking forward to it, guys.
Thank you, Drew.
So you guys, you just did a pretty big merger that you're working through with Star Royalties. Can you just walk us through the rationale for combining with Star?
Well, look, the easiest way is just to talk from their perspective. We paid them a premium, and they were going into a larger, more liquid royalty company. Why we did it is quite simple. It's accretive on a NAV per share basis. Everything's on a per share basis in royalty land. And it grows our cash flow per share by, call it 28-30%. So that accretion from a NAV perspective is always great, but that cash flow per share growth is what really gets people's attention in the market these days. And on the back of this, actually just happened last night, the key asset in that portfolio is now in construction. So the Copperstone asset is now going live. They put in a new PFS with over 100% IRR. Increase the resource there over 100% from the previous study, and it is going into production next year. So it's it certainly is been a great acquisition. And look, we're bringing on some good shareholders there too. There's a bunch of knock-on effects from the pro forma portfolio. How much of it is in production? How much of it is in development? It's a high-grade mine in the USA. You can't do much better jurisdictionally than that. So it's been a great transaction so far. We still haven't closed it. In about a month, we plan on. I think the shareholder vote's on June 22nd, so call it June 26th. Is kind of what we're looking. We're hoping to get this done in Q2, but it could spill into Q3. But that's what we're pushing towards.
Excellent. You answered my next question. I was wondering. So that's the remaining milestones. Is just the shareholder vote, and then you're good to go.
Yeah, exactly. Circular's filed. There's a lot of legal hoops to go through. I mean, this is the second royalty company we've acquired in 6 months. It's my third in about 3 years. So I'm not suggesting they get any easier with time, but yeah, these things take a little bit of work to get through it.
Excellent. That's great. Now, just wanted to talk about your revenue targets. And so you had a 10 million revenue target. You're going to blow past that because of this acquisition. Do you have a new target you're thinking about once some of the legacy Star assets ramp up in 2027? Have you talked about that at all?
So the stated goal, we had a portfolio when we came out of the gate that would do 10 million when everything's up and running. What do you do when you hit your target? You start a new one. So the next one is 20 million, which we think this portfolio will do by the end of 2028. If we can find more revenue producing royalties, we'll close that gap sooner. And then what will happen when we get to 20? We try to get to 30. And the idea here is it's not just about revenue, it's scale. And if you start thinking about the market cap that's associated with it, like my firm belief is that 20 million in revenue, 15 times revenue, which is a discount to our peers, you're looking at a $300 million business. We don't have to do anything to get there. Now, if we sit back, so you can make an argument very quickly at just over 100 million shares that this is $3 US, call it 4 Canadian comfortably, and we're trading at $1.50. So the revenue line is what really is driving things, but we're not going to lose sight of doing, smart, long dated options or longer dated options as well. We've done 2 deals this year. Actually, just prior to announcing the SAR deal, we bought a 1% royalty on Newmont's Saddle North deposit that was, 9 million ounces of gold and nearly 5 billion pounds of copper, basically abutting Newmont's operating Red Chris mine. So we're not going to keep, it's not all about cash flow, but that's really what's driving it. But yeah, I think, further to your point, you hit 10, now you're going to go to 20. We hit to 20, it's going to be 25, it's going to be 30. We're going to keep growing the business. Oh, okay.
So I was just saying, I noticed you've done a bunch of deals, but you've also done individual asset royalties. If the numbers work on both, is it your opinion that doing the deals can be easier sometimes? You can just get more royalties in the door in a shorter amount of time, essentially?
Portfolios are fun. And let's just say there's a portfolio of 10 royalties. There's typically 2 or 3 in there that carry the day, and then you get that optionality that comes with it. I guess from a royalty count perspective, the easiest way is to do portfolios. But look at one of our competitors called Versamet. They have fewer royalties than us, but they're doing big chunky ones. Like they just bought one on Skeena. They bought a silver stream on Rosh Panah. So we're not. It's about quality. It's not about royalty count. But we love having a nice round number of 50. Considering a year ago right now we actually had 0. So it's been a pretty furious pace.
Yeah, you've built something. All right, let's see. Capital structure a little bit. So you've raised a significant amount of capital without ever issuing warrants with it, which is pretty unique in the industry. So as you pursue your stated target of getting to, past 300 million market cap, can you walk us through how you intend to fund future acquisitions? Will you continue to rely purely on equity? At what point does debt become a tool for you? Kind of what's your thought process?
I think debt is already in our toolbox. One of our shareholders is Macquarie. We've implemented term sheets with them, never successfully. But we're having discussions with banks. Some of it has actually been inbound because if you think about the fact that next year we'll have 6 assets in production from the 4 we have now, this is a very good business to lend against. And what that enables you to do is actually go out and acquire assets on a non-dilutive basis, particularly if you're paying something a little bit higher than your NAV. Using that debt actually enables you to do things in an accretive manner at the end of the day, because you're using cash, you're using a note from one of the big banks to acquire these things. So we're excited to roll out with some debt in the future. And then from another perspective, we've got some really good institutions in the book. My chairman used to run mining sales at Scotia, Gerald Annette. So we've got pretty good access to capital. But I'm also a firm believer that money will flow to good ideas, and if we have a good idea, I think the capital will be there. Do we go and do an equity raise at some point? I never want to rule that out, but we have a lot of opportunities to sort of be smart about how we grow. The one thing that's interesting though is we're finding increasingly people want our equity because of the valuation we're trading at, particularly when we're talking to some of the majors that have large royalties in their portfolio.
Oh, that's an interesting angle. Yeah, so let me move on to valuation then. So you guys trade, between 0.75, 0.8 times NAV, which is a significant discount to royalty peers. They're around 1. What do you think the market needs to see to begin closing that? Like, you have conversations with investors all the time. What do you think they're looking at?
Well, look, we've been trading for less than 7 months, so we came out at 90 cents. We're $1.50 now for reference. The NAV per share according to Haywood's around 220. So how do we bridge that gap? It's just simply doing marketing outreach with groups like yours. We've got research coverage coming from a couple other spots. One guy internal on my team said your conversion rate's pretty good. I'd like to think it's because of me, but I also think you're selling a product that people want. So we need to just get out there more. I was at a conference last week. I'm going to another one next week. So certainly a lot of time on the road, and I think it's going to gradually happen with time. And actually, to make a reference to another royalty company I just talked about earlier, Versamet came out of the gate and was kind of flatlined for a little while, and then as they continued to grow their cash flow per share, they now traded a premium to NAV, and we're not emulating them and our friends over there, but like royalty companies don't stay cheap for very long, and we're certainly trying to accelerate that.
Yeah, that's a good point. Yeah, it's just earning the market's trust, and then eventually, when you have a track record, you get that premium if you're making premium deals.
Yeah, I would agree, for sure. But just because the stock's up 66% since we listed in November, doesn't mean that we think it doesn't have room to grow, especially as this cash flow per share continues to ramp up. Um, but what's also interesting about it from a valuation perspective is our growth is one of the highest out of the sub-billion, call it sub-$2 billion space. All of that growth, there's only one asset left to go into construction. All of it is being run by eight or $900 million companies with permits that operate nearby. So right now we've got a green light and a fully funded asset in Copperstone. I think we talked about before going on air. Minera Alamos is putting that in production next year. Jaguar Mining is putting on one of the satellite deposits called Pitangui. That goes into development once they get their installation license permits sometime later this year. So all of this NAV is either going to be in construction or producing. And I would argue that should trade at a premium, not just on a peer average. I think it should trade at a premium. And maybe I'll argue for a premium when we get up over $2. But right now, I mean, just arguing for the simple one turn of NAV is kind of our goal.
Yeah, that's definitely attractive. Let's round things off with catalysts. So, what are the major operational catalysts that investors should watch for? What are you looking for that you're most excited to see develop in your portfolio?
Well, we had one yesterday. No, we don't own the Copperstone royalty yet, but that is when something is in construction, you get that multiple. It'll go from 0.5, 0.8 to 1 times NAV, and then ultimately higher than that when it goes into production. So that's great news. Ongoing commissioning at West Red Lake's Madsen mine is great to see. They're gonna have a strong second half. I think that's gonna get bigger and better as it goes along. It's a slower ramp up. It's not the easiest mine in the world, but that's going really, really well. We've got a PEA coming out on Banyan, where we have a 2% royalty on the airstrip deposit and a 1% on the western extension of Powerline. That's coming out of the PEA, and they're calling for over 300,000 ounces a year. I don't think investors can ignore that. So, if you look at Banyan and Copperstone pro forma, I mean, those are very valuable royalties within our portfolio. And then, quite simply, some of the stuff is just continuing to execute. The silver stream we have at Orezone is they declare commercial production in January. We just get a check every month from those guys. It's going great. But and I guess the last one I should touch on is Zancudo. We haven't talked about that one. We have a royalty down in Colombia. They're doing a direct shipping ore operation right now. They're installing a 1,000 ton per day mill later this year. That'll see it ramp up to 45, 50,000 ounces a year. That adds another million and a half bucks perhaps to a revenue line. So all these assets are turning on, ramping up, or going in the right direction. And then from the corporate side, I think I touched on it earlier. we're going to keep getting out there and setting the word around. But we expect to see some more research reports out of Bay Street here that'll sort of give us that third party validation for more than just one party. Yeah, the portfolio is in great shape.
Drew, this is a great conversation. I don't know if I've seen a royalty management team running as fast as you guys are. So it's very interesting. We'll be watching you guys closely. Thanks for stopping by Hard Money.
Real pleasure, guys. Thanks a lot.
Thank you, Drew.
All right, that was Drew Clark, CEO of Summit Royalties. The train keeps rolling. Don't go anywhere. We'll be right back.
Welcome back to Grizzle Hard Money, a dear friend of the podcast, Mark Brennan, CEO of Cerrado Gold. Mark, always a pleasure. Always great catching up.
It's amazing. I'm thrilled to be back talking to you guys.
Thank you.
So, Mark, let's kick it right off. Could you, for people who don't know Cerrado as well as we do, could you kind of go through what assets are most important to the company today and which will potentially be most important in the future?
Well, I think we have three assets that all are equally important because I see strong value creation in the short term. But I think the most critical asset we have is MDN in Argentina, producing gold mine that is producing around that 50 to 60,000 ounces for the last 2 or 3 years. Really important is we've just kind of gone to a path where we're looking at about a short mine life of 2 to 3 years, and now we're highly confident that we can see that mine life, pushed to 5 to 6 years at that 50 to 60,000 ounces through an acquisition that we announced earlier this week. We still have to catch up with the technical work, but at the same point, we're very encouraged by what we see as establishing a longer mine life, which will allow the production to ramp up from that 50 to 60 to higher levels. On top of that, we have a Portuguese asset that we hope to resubmit a IEA or proposal, as well as a detailed engineering proposal. And with that project, we're hoping that that project is approved and in construction by July of next year. On top of that, we have another project in Quebec, a very significant and large iron ore asset, high grade, high purity iron ore, so DRI, direct ship product, that basically has extremely strong economics that we're contemplating. We're finishing a feasibility right now. And we think the feasibility is going to be extremely robust and provide strong indication of great value for shareholders in the short term. But that project will be looking to go through the permitting process in Canada and Quebec, which takes a little bit of time, but we expect to be in construction in that project in early 29.
Great. Amazing. Great overview. Now, before I get on to kind of your outlook on things, you guys announced some news yesterday. You're acquiring a property, Falcon, I guess is the name of it. Could you just walk through the rationale for that and what it will help you do it at the MDN property?
Yeah, well, I mean, I think you guys will remember, last year we really focused on transitioning, creating a strong balance sheet and financial strength. On top of that, we were focusing on stabilizing the operations. Prior to that, we were always fighting Argentina MDN a little bit in terms of getting a life of mine. This adds to that equation of stability and extending life of mine. Again, we need to prove this up, which we hope to do in the next 3 to 6 months. And basically what that'll mean is that we can show, we want to be targeting around a 5 to 6 year life of mine. And then on top of that, really critical for us is to anything beyond that, we have the ability to put into our production facilities, which should hopefully drive our guidance 50 to 60,000 ounces this year to higher levels. So from that regard, we have 3 different areas that we're looking for strong growth in terms of our production capability outside of life of mine. And that's going to come from our underground operations on the existing operation. It's going to come from the expanding and getting higher grade material for the heap leach. And then also through a 50,000 meter drill program that we're working on right now to drive higher grade material through the plant. So those are the 3 key areas that we're looking to do it. Now, as part of the acquisition we announced yesterday, Falcon is one component of that strategy, where we're looking for regional consolidation of the northern area of our property. At Calandrias, that's the backbone of the production right now, which is the heap leach operation. We acquired what's called Falcon. This was a project that was owned by Pan American Silver, but previously a lot of work had been done by Yamana at a consolidation strategy to the north for lower grade material. Now, Pan American, a big company and more focused on silver, but their focus is really being on higher grade material. For us, having a lot of lower grade material is very economic. So from our perspective, we're kind of following up with that Yamana plan that was in place to drive significant ounces in the northern area. And we think that, we're going to see a long term life cycle up there with also, very strong capability for generating a lot of cash.
Great. That's a helpful overview there. So I just want to move on. You have a great slide in your deck that lays out the upside potential from your future projects, which you've talked about a little bit. Could you just walk us through your long-term vision for Cerrado? I'm curious, these other projects are not typically, they're not just gold projects. So how do you see the commodity exposure changing over time as well?
Yeah, I mean, great question, Scott. And really what we're looking at is, the focus that we have is, as a junior company, we're really focused on cash flow. That is our most important element, and cash flow per share. That's a very important metric for us. Okay. So what we're looking at is to find the best assets we can, that we can drive the most cash, while we have the technical competence and the financial ability to drive the projects. So initially, Argentina, if we were to go down the common cycle that you see on this slide presentation, we have Argentina producing 100% of our cash right now through gold predominantly. When we bring in Portugal, that'll bring our gold and precious metal content down to about 60%. And then obviously when we bring in the iron ore project in Quebec, it brings that down fairly dramatically. Now you'll notice on that slide that those three different assets, these are all based on historical studies, historical 43-101 studies. And so I'd say that MDN is a little outdated from the perspective that we're growing MDN. We're generating a lot more cash at MDN. So as we move forward, MDN doesn't have to become secondary. We think MDN is still at the very early stage of the development cycle. If you look at another slide in our presentation that shows the history of the massif in which we're on in Santa Cruz, basically it shows how groups like Anglo and Cerro Vanguardia, how Newmont with Cerro Negro, how Yamana, now Pan American, developed Cerro Moro. We are the young kids on the block with very little exploration done. We've done less than 40,000, 50,000 meters of exploration drilling, where these other projects that are producing, 1, 2, 400,000 ounces a year basically have done, 2,000 meters of drilling, 2 kilometers of drilling. So far more drilling on exploration than we have. And so from that regard, 2 million meters of drilling, excuse me. Whoa. So from that perspective, we are very new, and we are just starting this whole journey, I guess, at MDN with respect to driving resource growth. And so I don't necessarily think that MDN, we're not in MDN for a short-term low production scenario. We think this mine has lots of room to expand. I'm not going to tell you it's going to be as big as Cerro Vanguardia that's produced 6 million plus ounces to date, but I'll tell you, right now we don't have any indication that it can't be. So we think that it's a very young project with lots of opportunity to grow. And I'll say the same thing for Portugal. In a very short period of time in Portugal, we took that from 9 million tons to 27 million tons. And the fact of the matter is that we think that can go to 150 to 200 million tons. That would be our internal kind of desire for the project. So each of these projects, independently, have substantial capability to grow. And probably the ironic thing is that the project that we have in Quebec, while probably the furthest away, is the one that we have the most we have the most mature resource with 1.1 billion tons, and 550 million tons of that are in the measured and indicated and proven and probable category once we complete the feasibility study at the end of June. So the fact of the matter is, what I'd say to you is, the importance is not so much to focus on the difference in the commodities, because I think at the same point, gold, by the time we bring Portugal into production or even Quebec into production, we hope that MDN is going to be a lot larger. Again, the real critical item for us is that finding assets that we have the ability to grow, that have potential to be world-class in size and scale, but also that financially we have the capability to drive. And so, if you look at what this plan does, we believe by according to the dynamics here, we believe by 2031 that we'll be in a position to generate over 300,000 ounces equivalent of gold through all three of our projects, with very limited additional expenditure or raising of capital for our shareholders. So from that perspective, we feel very, very happy about the future that we have for all three of our assets.
That's a great overview. Thanks for taking us in your head a little bit, how you think about it.
Well, and Mark, I've always been impressed, like the way you think. You really do think about it from a dilution, like just the idea that it's about growing per share metrics, right?
Yeah. Well, I think if you look at that slide that Scott was referring to, I mean, I think the number translates to about 500 million of free cash flow. And I would say that gives you a business that I have to believe would be on a Canadian or US dollar basis. All the numbers I talk about are US. Would probably give you a business $2 to $3 billion of business, which we can have within the next 6 or 7 years. That from a market cap, that's a tenfold increase from where we are today. So I see lots of potential, and again, I see lots of potential growth within that scenario as well. So on a per share basis, coming back to your point, there's lots of shareholder value here that we're looking to uncover, which is a little bit when you asked me earlier about which one is the most important to you now. Again, I think that when we announced that the feasibility is complete at the end of June for Quebec, I think that's going to have the ability to generate substantial shareholder value immediately to shareholders because of that value that we see. And then on top of that, obviously Portugal is a little bit in a peculiar state right now, but we're very comfortable that the path we're taking will lead us to a construction scenario in the summer of next year. And once we can show that, and we can show the dynamic of that, and publish our new feasibility study to that effect, I think that'll give, when we're in that position to do it, probably in the third or fourth quarter, that'll give us the ability to generate cash for shareholders and cash value for shareholders as well. So I think all three assets are going through their development phase. The important thing is that we've spent a lot of cash in terms of bringing these assets to kind of where they are. As we move forward, Quebec and Portugal are going to have very de minimis cash requirements until they go to the construction phase, at which stage those assets will be ring fenced and will be, they'll be able to be funded independently from the other assets of the company. So from that regard, we see very substantive shareholder appreciation potential as we move forward.
That's great. Now, Mark, I just wanted to move to the permits on your two growth projects. Can you just walk us through what the major permits you'll need for Portugal and Mont Sorcier, and the timelines that typically occur with those types of permits?
Sure. I mean, if you look at, let's talk, if you look at Portugal, we submitted our environmental impact assessment in November of 24. We received a request for a couple of adjustments in May of 25. We made those adjustments in spades. The one was that no use of cyanide, even though cyanide can be managed conscientiously in good practice. But we understood that request to get rid of cyanide, and we got rid of cyanide entirely. The second thing was just dealing with the water aquifers on our site, and we've had the most sophisticated hydrological studies done in Portuguese mining history. We had strong approval from initially from the evaluation committee for water management. And independently, the president of APA, or the regulatory agency, decided that this project was not going to go forward. So there's been some issues that we've had. We believe that there's been an element of there'd been some irregularities, and the fact is we filed an injunction with the courts in Portugal. We believe that and we also filed a lawsuit for the longer term to make sure that our interests are protected. And I think that the course of action that we're embarking upon will be to file that the environmental impact assessment again or a little bit of a revised assessment in by December 1st, as well as with detailed engineering. And subsequent to that, we would estimate about 150 days before we get approval for that. And we strongly believe that we will get approval for that, which would put us in a construction position in the summer of 2027.
Okay.
And again, we still have the very strong support of the UK Export Credit Agency, as well as we're working with Santander Bank, very serious entities. We think that most of the funding, if not all of the funding, can come from the bank as well as third parties. Traders are really looking in Europe. They really want product, and we think an offtake can probably successfully make up for any of the cash requirements we require. So again, we think we can bring what you look in front of you and you see the kind of cash flows that we were talking about 75 million. I think that's a historical number, and our hope is that with the new feasibility study that we'll announce probably by the end of the summer, that basically the numbers will be improved from there. But we'll be able to bring that on stream with very little cost to Cerrado shareholders. And then if I look at Quebec, again, we're targeting the feasibility study to be completed by the end of June, and published by the end. We'll put out a press release before the end of June, and the target then will be in the first quarter of 27 to submit our environmental impact assessment. In Canada, generally it takes about 2 years to get these things approved. So we're contemplating that probably in early 29. That we can have this project in construction, which will take a couple of years, and so by 31 we would be in production.
Great, that's very helpful for that roadmap.
Yeah, Mark, a great overview. Now, just looking forward the next 6 to 18 months, will you give us some catalysts ahead on the roadmap?
You already covered some, but if there's any that you think were...
Well, I think it's important to note that we have a path in front of us, as you highlighted on that slide, that we're following, and we're always, just like this new strategy in Argentina, the regional strategy for consolidation. We're always looking at different and new ways that we can improve shareholder value and that we can drive value to our share price and market cap. So, will we look at other assets? Yes. Will we do it at the expense of having any impact or negative impact to our growth profile for the future? No. So I would say to you that again, with the assets in Quebec, feasibility study, if we have an NPV of $1 billion, we should trade for, and all numbers again, US. If we trade, we should get at least 0.1, maybe 0.2 for that asset. That would give you 100 to 200 million US. So I could see some strong value coming into, and I don't think that's necessarily being crazy. On top of that, again, Portugal, if we can look at Portugal, even if we use the historical PA feasibility study, which I think we're going to improve upon, that's 150 million NPV that basically we're getting very little credit for right now. If I look at Argentina, if we can show people that we've got a 5 to 6 year mine life at that 50 to 60,000 ounce production rate, with an all-in sustaining cost of around 1,800, which is our target, I think we could add 100 million, 200 million to our share price. So those three elements alone, I think, have the capability to add, if you do the math, 300, 400, 500 million to our market cap. And I think that's without being crazy. Now, I'm not saying the market's going to give it to us, but I don't think at the same point it's unreasonable to think that it's possible. So those are three direct metrics on the three assets that we have. And as I say, I think we're always looking at different ways to with the addition of Falcon, potentially we're looking at other assets to bring into that consolidation strategy. Again, we'll extend my life, increase production. We could hopefully see before the end of the year some other components that'll drive value as well.
Mark,
Excellent.
always a pleasure. Thank you for the great overview, Cerrado Gold. And obviously we'll be in touch through the year. And Mark, a big thank you for joining the stream.
Yeah, thanks,
As we have been, and I really appreciate it, guys. And thank you very much. And we look forward to a great year ahead. And thank you for all your support.
Thank you, Mark.
Thank you. All right, everyone, hard money. We're going to keep on rolling. We're taking a quick break. Don't go anywhere. We'll be right back. All right, everyone, welcome back to Grizzle Hard Money. Train keeps rolling. We're very excited to have a guest you've seen before, and it's always an amazing conversation. Let's say hello to Leigh Goehring. He's co-founder and managing partner, Goehring and Rozencwajg. Leigh, good to see you again.
Thomas and Scott, great to see you guys again. And like I said in my previous podcast I did with you, which I think was back in mid-December, I love doing this stuff. So thanks for having me back on.
Wow,
we love having you.
Yeah, you're a staple for our. We have two bookends in the year. It's the Outlook Commodity One-on-One conference in December, and then Hard Money. You're an important part of both of them. So Leigh, always a pleasure.
Now, Leigh, I want to start off here a little high level. I'd love to get your thoughts on current events, specifically Strait of Hormuz blockade. Are you surprised oil never really went above 120? And also, how much longer do you think global inventories can hold out before we really see a supply pinch? Because, prices have been pretty modest, all things considered, versus the fundamentals.
Yeah, and Scott, I can answer those questions, but I'm going to step back a little bit. If you remember when we did our podcast back in mid-December, I said that oil market had bottomed and you were being given the buying opportunity of a lifetime in oil, very similar to the buying opportunity that you were given in gold back in 1999, 2000, and 2001. And just like no one paid any attention to the gold market back in those years when gold was the most radically undervalued asset class, oil, we believed, had fallen into that same uninvestable, radically undervalued category, and you were given being given a great buying opportunity. Now what's happened is that the bull market has started. No one is willing to admit that the bull market has started. Everyone thinks that this is a temporary move in oil based upon the closing of the Straits of Hormuz. But I believe that this is only the first leg of possibly a bull market that's going to take oil significantly higher. Now, also, I remember in that last podcast we were talking about gold back in pre 2000, end of 2025, like 2022, 2023. They said when a bull market starts, there's three legs of a bull market. The first move no one believes, the second move convinces everyone, and the third move is they eventually buy it. And of course, what you're seeing now in the oil market after the Straits of Hormuz, you've had, oil from the time we talked in mid-December, oil basically rose almost 100%, because I think oil was like 57 or something like that, and it got as high as 120. So it almost rose 100%, and it's pulled back here. It's still up 60%, but everyone is fighting it. Everyone says, oh, this is all temporary. The world is still in glut mode, things like that. And I don't think that's true at all, and we'll talk about it in a second. We are moving very, very rapidly to a huge unadulterated crisis in global oil markets. And like I said, it's going to be just like what happened in April 20th, 2020 in reverse. Now, if you remember what happened back then is that the month of April started off, oil was about $30 a barrel. There was tremendous oversupply. The Saudis and the Russians were in this big, huge market share pricing war. COVID had basically driven oil demand, down hugely, and there was a big worry that storage global storage for oil was actually going to overflow. And so what happened is that oil went from 30, it ticked down, it ticked down, it ticked down, eventually got to 20. And then on April 19th, it started to collapse. And on April 20th, it went to almost minus $40 a barrel in the futures contract. Brent did not get that low. It got as low as, I think, 12 or something like that. It was still positive. But it was the first ever negative print in a global futures market as far as I know. We are going to repeat that except in reverse. We are now drawing down global inventories very, very rapidly, unprecedentedly, and the market is still in complete complacency mode. And I think that there's two factors at work. One, as I just mentioned, the first move of any bull market in a commodity or even a stock, no one believes it. So everyone's fighting it. In fact, so that's that. And then there's something else going on. We probably haven't talked about this on this podcast, but there's a phenomenon called the carry trade going on now, where you basically you take cheap borrowed money and you buy long duration assets with it. And the way you fund the purchase of those long duration assets, which are now, it used to be you borrow Japanese yen to buy Australian 20-year bonds and stuff like that. That'd be the classic of that trade in practicality. But now what you do is you're borrowing money from your bank or whatever, and you're buying the Magnificent Seven or, Micron Technology, yesterday, things like that. So what you do is you're piling into these long duration assets. And of course, the NASDAQ has made up, a significant new high, Micron Technologies, which is the stock du jour, is putting on, close to $100 billion of market cap a day. And I remember when the biggest stock on the New York Stock Exchange was Cisco back in summer of 2000, and it had, I think, 650 or 700 million. Now you're putting that on every other couple days in these trades. So the hedge funds, the algorithmic traders piling into those long duration asset trades, you have to fund it somewhere. And what do you fund it with? You fund it with short duration assets. In this case, you fund it with oil and oil related stocks. And so I think that is one of the reasons why the average investor, he doesn't believe it, because like I said, the first leg of any big bull market move, no one believes it. And the second is the fact that the algorithmic hedge fund community, which is piling into these the magnificent sevens or whatever they're called today, has to fund it some way, and they're funding it by shorting short duration assets. And I think oil is in that short duration basket. And I think that is what's causing this very muted response. Also, remember the futures market is the prompt contract is telling you what's going on today. And as of today, there's still enough inventory in storage so that you don't have shortage situations. However, that is going to rapidly change starting any day now. And what's going to happen is we are drawing down to tank bottoms. We're on that trajectory. Where we are exactly, we don't quite know because we don't have real-time data, but we're going in that direction. And just like what happened on April 20th, when all those futures traders that were long physically traded NYMEX oil contracts, they had to sell them. Somebody had physical capability to take delivery of that oil. They couldn't because Cushing was basically filled. And so we went minus 30, collapsed to minus $37, $38 a barrel that day. Like I said, just the opposite is going to happen. One of these big traders, Glencore traders, Trafigura traders, Vitol traders, they're going to wake up, and the refiners, their refiner is going to say, I need oil. They're going to go out to buy it, and they can't find it. It's not going to be there. You're reaching tank bottom. And the funny thing is they're going to get a bidding war with each other. And so the thing is, it's just we're going to have just the opposite situation happen on April 20th. I suspect, oil's here at 90. We're going to go home some the end of the week, and oil's going to go from 90 to like 105, and then it's going to go to like 115, and then it's going to go to like 125, and then maybe a weekend, and then we wake up on one morning and it spikes to 200.
Wow.
And
So
you say, well, how can that happen?
in
I
that
said,
kind of
well, yeah, I think it'll happen fast. And because I think that, remember, if I'm right, that this just piling into this NASDAQ 100 trade right now, it has to be funded by someone. Obviously, you're going to be funded by selling oil, basically shorting things like the XLE and oil futures and things like that. And I think that those have to be covered. So that will be caught up in the frenzy, the buying spike frenzy that takes place. So, and I suspect you're going to see huge losses take place on that trade. And it's interesting. Just you have to understand the mindset of like, for example, what is a hedge fund? A hedge fund, 99% of the people in the hedge fund business, they trade a trend. And like I said, being short oil has been a very good trade to do over the last 15 years, whatever. Especially use it as a funding mechanism to fund the carry trade. It's worth very, very well. So the thing is, that trend, they still haven't been able to fix their mind that trend has been broken, and that trend is no longer being in place. And you saw it at work. Literally, on Friday, when all Bloomberg was filled with the various naval U.S. task forces are all streaming into the Gulf, all these rumors that they're going to bomb Iran and things like that. All the big trading houses went home short oil on Friday afternoon, and they took a huge amount of losses on the following week on that trade. Now, it was all couched at, we were shorting the number 5 diesel versus number 4 high spec home eating fuel, and that trade came undone. No, they were basically short, and overall, and so that's going to happen again.
So
it's going to add to the buying power, buying frenzy to the upside.
Yeah. So Leigh, so you do think there will be some casualties here in the hedge fund industry, when this all plays out among traders as well?
I think that they are,
you think traders are, or broadly speaking, there will be traders that'll get caught out.
Yeah, I think there'll be some traders, although maybe they've learned their lesson. The big trading houses took big losses because they were net short various product and whatever. It's not clear what exactly was short, but they were definitely overall short. But I think this time it's going to be the algorithmic trading and hedge funds, and it's just it's just look at the way the NASDAQ is trading. I mean, it's putting on trillions of dollars of market cap every day.
Yeah.
And if you're an algorithmic trader, and you're running one of these market neutral books, as that goes up, you've got, it represents more of your exposure. You've got to short something against it. And like I said, you short duration assets against it. And oil is a short duration asset that has worked beautifully as a funding mechanism in that trade over the last decade or so. And they can't give it up. And I think that's one of the reasons why oil's been lagging here, besides the fact that we still have enough inventory before the crisis hits.
Leigh, like, obviously we had to touch on oil. You could not. It's hard money, but we have to touch on oil. But now, touching on gold and hard money assets in particular, America's fiscal situation continues to deteriorate. We have an inflationary backdrop, an incoming new Fed chair, many cross currents that the market is wading through, particularly for gold. Right? When you look at relatively the commodity complex as a whole, gold year to date obviously has had a stellar year, but year to date flattish. What's your outlook for gold over the near term, and then also over the longer term with these cross currents in the back?
Yeah, in fact, again, Thomas, I'll step back to our last interview done back in mid-December, and we spent I actually went back and I watched it to make sure that what I'm saying is actually true. I'm not making up in my mind. But we talked extensively about how we were reaching what we believe that the huge bull market in gold, which basically started in the end of 2023, and no one paid any attention to it for the first year and a half until the mid 2025, that you were reaching a situation in the gold market that had been reached before, which was going to generate what we believed a very strong sell signal in gold. And that was the fact that silver, when we were talking December, was about 2/3 the way through a massive catch-up rally with gold. And I remember in the interview, because I just listened to it, I said when silver hits 75 to 80, that the sell signal will be triggered. And it turns out that silver vastly overshot that and actually hit 115, I think, at the end of January. So, and what, just stepping back, what was the silver sell signal? Is that there's been 4 and now 5 times in the last 50 some odd years of freely trading gold and silver markets that a situation develops where gold has a big, huge bull move. Silver lags most of the original gold bull move and then plays and undergoes a tremendous catch-up rally that basically overtakes all the underperformance, undoes all the underperformance, and then shoots to the upside, overperforms. And the thing is that happened in 73, 74, happened in 79, 80, happened in 2010, 2011, and happened in 2020. And after each one of those times, it made significant amount of sense to get out of the gold market, everything precious metals, gold, silver, equities related as well. And we believe that now we talked about in December that we were on the verge of triggering it. We did trigger it, and we recommended that investors significantly reduce their precious metals exposure, which we believe is now in the process of working out. Now, what's the significance of the silver sell signal? Is that I think what it represents is that, like I said, gold begins to move. No one believes that they eventually they grab onto it, second and third legs, and they decide in the end to buy silver because it's leveraged and it will be the more high volatile metal, which after that silver makes that big move and everyone piles in, you know that the most of that gold bull move is over. And, in 74, post 74, gold retracted 45% within a bull market. Post 79, 80, it retracted 65% in the next 2 years. 2011, it retracted 45%. And in 2020, it retracted 25%. It was the most mild. We believe that we're in this period where gold is going to be what I call a very frustrating asset class going forward. Now, the question is it going to have a very, very steep pullback here like 74, 75 and 2012, 2013, or is it going to be very, very relatively mild that happened like in 2020 to 2023? The question is, I don't know, but I think it pays to have, if you're like us in the performance business, it pays to minimize your exposure to gold and silver markets going forward for at least the next couple of years. Now, long term, where it's funny, Thomas and Scott, you bring up an extreme point with global sovereign finance and things like that. I don't think this gold bull market is over. In fact, I recommend if you're a retail investor and you don't have the performance constraints that we do, that we always have to be in the best performing areas of the market, just hold on to your silver, hold on to your gold, and the idea that use any weakness that develops in the next couple of years to buy even more. Because I think I actually talked about this in our last podcast. I said the big bull move in gold from 2023, 2005, what it was used, the D word was mentioned as a reason, the debasement trade. And that's what pushed gold up. People realize that the dollar is going to be debased. However, that's what drove gold from 1800 to 5400.
Yeah.
That was the trade that got people so excited. And so the thing is, I think that's incorporated in the gold market right now, and we'll have to work that enthusiasm out. However, the next leg of the gold bull market is not going to, it's going to be driven by the D word again, but not debasement. It's going to be driven by default. And, one of the things about gold is that people will realize that gold is unique, and, maybe crypto shares this as well, but I'm not so sure. That gold is unique in the sense that it's the financial assets, which is no one else's liability. And in a world where sovereigns are defaulting right and left, which the biggest default is going to take place is going to be the U.S. government in some form, is that people will gravitate towards it hugely. And the idea that that's what will drive the next leg of the bull market. However, between that next leg and now, again, the 1970s is a nice overview. Gold started at 1970 started at $35 an ounce. Nixon removed the U.S. from the Bretton Woods Gold Exchange Standard in 71. Gold ran from basically 35 to 40 up to almost 200. Had that 45% correction from 74 to the end of 76, and then it had a massive second leg. And I think that we're in that 74 to 76 period right now. And the question is, prepare yourself emotionally that the next leg of the bull market is about to happen. But like I said, I think it's because there was so much enthusiasm generated in the gold market, as represented by that massive bull move in silver that took place, that I think gold is going to trade at best sideways, and depending on the direction of real interest rates, could very well have a significant correction. So,
And maybe your
and like I
thoughts.
said, I would say, if you had to put your money in gold or oil, put it in oil right now, even to those levels.
And maybe just your thoughts on an incoming Fed, and is there a scenario where we do see a very dovish setup where people get concerned about everything, right? It does become a where the barn door is open for all commodities, and I guess the second point is also one of the other assets in hard money that's been languishing has been Bitcoin. Just wondering your thoughts around how much money that would have gone into gold has gone into Bitcoin and may now be slowly trickling back. Just probably twofold question there. A, on the Fed, and then B, just your thoughts around capital migrating back to gold from Bitcoin.
Yeah, well, Warsh is always prided himself of being a hard money man. He disagreed vehemently with QE. He believed that the Fed should have been raising rates when they were lowering them. And the question during his beauty show to convince to hire him, he had to promise that he was going to lower rates. And the question is, given the fact that all that beauty pageant took place, starting a year ago, that he could have made some justification based upon the conditions at the time that he could lower rates. But the question is, how in the world are you going to lower rates now? Inflation pressures are accelerating. And if I'm right about what's going to happen in the global oil markets in the next several months, is that it's going to be impossible for the Fed to raise rates. And the other thing too is that Warsh, now we'll have to see how this works out. He's a big critic of QE2 or QE, I'm sorry, and we're in QE4 or QE5 now. And the question is whether he's actually starts to shrink the Fed's balance sheet, which, mind you, is very, very contractionary. And it would be like raising, the equivalent of raising rates in some capacity. But the funny thing is that I think that he's going to, given the fact that these inflationary pressures are only going to get worse, that there's going to be a call for the Fed to do something about the inflationary pressures, just like there was a call starting in 2021 to do something about it. They didn't. And you had inflationary pressures really, really surge in the next year and a half. And the question, can he lower rates? And my gut feel is, I have no idea. I have no insight into this, but my gut feel is he winds up raising rates. Really? And of course, that's and that's what's going to be bearish that's what's going to really put pressure on gold, because the other thing that's interesting, you look at each one of those silver sell periods I talked about, 74, 79.80, 2011, 2020. What followed after that made the gold price go down? Real rates went up in each one of those instances after that. And the funny thing is, I could see in the situation now, given the inflationary pressures, that real rates go up. And so that's going to cause Western investors to sell and cause a lot of downward pressure on the gold market. So the question is, that's my gut feel what happens. Now, as far as Thomas, you asked about Bitcoin and cryptos, we've never been believers in crypto here. We think there's a couple structural flaws that are involved in the crypto markets, including the fact is, you're realizing that, especially people that want to use it on a daily basis, it is hackable. It is hackable. And the thing is, this last big hack that took place just in the last couple months, and it's almost beyond my ability to even understand how it took place, but it did. And the funny thing is that I think that we're going to find out that crypto. Now, I'll make a great prediction that probably in 20 years we'll look back and our children or even the grandchildren that'll be starting to emerge. Then will say, Granddaddy, what was I read about crypto? What in the world was that? We might not even have any idea what it was in 20 years time. So I guarantee that gold will be there. Gold will be there. It told you it gave you its signal how important it was over the last 2 years, and it's not clear whether crypto is going to stand the test of time.
Yeah, no, great points. And so one area, Leigh, you've had great foresight in terms of the commodity markets, and I still remember, I think it was 2 years ago, you guys put out the great piece on gold equities, the value of what's in the ground, and gold equities have outperformed gold physical, and for equity investors, which are predominantly our audience, your thoughts on just obviously that's that's been a change in the past, right? In the past, that was the reason GLD, your gold bullion was getting more flows than gold equities. It feels like we're finally in a place where gold equities are outperforming physical gold. We just had Kinross on, and just their metrics are like a 10% free cash flow yield. I don't think we've, that to me is just an incredible place to be. Maybe your thoughts on for an investor that's wants to be in precious metals, are you still viewing the equities as the preferable place to be relative to the physical?
I do, and there you can envision in your mind a scenario, because again, going back to all those previous sell signal periods I talked about, precious metals equities did much worse than the underlying precious metals themselves. So they were definitely the levered way on the way up, and they were the levered way on the way down. So you definitely, in each one of those cases, you didn't want to be involved in the precious metal equities. This might be different for only the very reason, in our last podcast, we talked about one of the most bizarre things that happened in the gold markets and gold equity markets in that period between 2023 and the end of 2025 is that the number of shares in the GDX, even though gold stocks were the best performing asset class out there for that 2-year period, the number of shares in the GDX declined by 30%. And when we talked in December, the open interest or the number of shares outstanding at GDX were still declining. Investors, again, back to that first move, no one believes. It's the second move that convinces, and the third move they buy. Obviously, this first move, not one person believed it. In fact, I remember talking about it. I said maybe the entire move in gold shares that took place from 2023 to 2025 was one massive short covering rally.
Right.
It could have been.
Yeah.
And
it's a great point.
The funny thing is that so we might be in a situation where gold goes down 45% and gold stocks only go down 20%. But it's hard for me to imagine in my scenario that they would actually go up. But they might, ironically, I'm not gonna recommend people own gold stocks versus gold, because I worry that the gold market may actually do worse if we start raising rates. But you could make the situation that gold stocks are really cheap, and they've had almost no inflows in them during the bull move, so they might outperform on the way down in the next 2 years. But the thing is, I think you want to prepare yourself.
Leigh, all I was going to say is, there's an argument, if the capital allocation is actually good this cycle, you could be getting your 10% free cash flow yield versus owning the physical. But that only assumes that these guys still stick to their guns on costs and everything else, which in the past they've fallen down on.
Yeah, it's hard. And I know we've talked about this in previous podcasts. Gold mining is a miserable business. It's not like being in the copper business where you're mining copper porphyries that literally have somewhere to 75 to 100-year mine lives. You have to, your average gold mine, your epithermal gold deposit has, basic maybe 15 years of reserve life if you're lucky. So every 5-6 years you have to think about reinventing yourself just to replace your asset base, which is depleting, and that's why it's a miserable business. And I always say, don't own gold stocks unless you really believe that you're going to have a really big, robust move in gold prices, because that's where your earnings are going to come from and your value, because everything else is against you. These poor companies, their costs keep going up because they have to, everything, in this case, oil prices, everything is, the inflationary pressures are against them, and they have big depletion issues. And the thing is that you're overcoming that all the time. So unless you're really bullish on gold and silver prices, I would say sit on the sidelines and wait. I think you can get a great buying opportunity in the next 2 years. Very similar to the buying opportunity you got back in the end of, the midsummer 1976 into the fall of 76 was the bottom, and then boy did precious metals and stocks rip after that. So,
Leigh, fantastic. And so obviously we always ask to wrap up, and you always have great foresight here. Over the next 12 months plus, what are your top 3 commodities? I think you gave one of them in oil. I think that may take your top position. What I think the different point here is that you have this strait that's blocked. Lot of commodities are getting whipsawed with respect to supply. How would you think about this? Is going to be a fascinating 12 months in how the world deals with it. Maybe you can talk about how you're thinking about it, and is it all through that lens of how Iran plays out?
yeah, I think that's going to be the most important thing, because I think that's the people that have, earnings leverage to higher energy prices going for the next several years, which is going to be, occur because of what's happening in the Middle East today, will be the winners. Now, you're dying, and I brought this up in our last podcast. What I think is going to be one of the better performing groups going forward. It's a commodity that's a 4-letter word. You can't go into a polite cocktail party situation and say it and not be completely ostracized, but it's COLA. And I think that is the asset class that I think if investors can buy it, I think that's what you should be buying today, because there is huge. You see, no one follows the coal market anymore, and the funny thing is, no one pays any attention to the underlying fundamentals. I mean, if somebody wanted to find out about it, your broker wouldn't know anything about it. But the funny thing, there's been a number of huge positives that have taken place in global coal markets, including the fact that the U.S. is now talking about building its first new coal-fired plant in Alaska. And I mean, and the idea, obviously, the shutting of the Straits of Hormuz, all about 8 or 9 Asian countries have all announced huge up ramps in coal consumption to generate electricity to replace their LNG. I think one of the things that's going to happen there is they're going to say, okay, we're like, for example, I think Korea, of their 60 coal plants, has been planning to retire something like almost 40 of them in the next 7 to 8 years. I suspect that they're going to say, well, maybe that's not such a smart thing to do. Coal is cheap, it's reliable. Maybe we'll keep those plants operating. Same with Japan. And so the thing is, every Asian country now is seeing a surge of coal consumption, and we're actually seeing year-over-year coal consumption growth in the United States because of very strong electricity demand. These coal plants have not been operating at full capacity, and their owners have been turning them back up, to operate full capacity. So last year, U.S. coal consumption actually went up by about 7%. And finally, the world's largest coal exporter, Indonesia, has said that they are going to cut their coal exports by some huge amount. And the thing is, Indonesia has been exporting like 550 million tons of coal a year. And they're going to cut that by 100 or 200 million tons. And so you have strong demand, you have supply being curtailed, and you have stocks that no one pays any attention to. So I would recommend coal. I recommend highly U.S. natural gas. This is a trade like Doomberg loves to just put his finger in our eye on this trade and say we're wrong. And the funny thing is that yeah, and it's interesting. Get this. He's recommending gold, and he's recommending basically, I shorting oil and gas. So he's recommending the asset class, been the best performing asset class after the last 25 years. It's up 20-fold. Stock market's up 7-fold, and he's recommending asset classes that have been huge bear markets for 15 years. So I guess if you want to be a trend follower, that's the way to go. Yeah. But the funny thing is, I think U.S. gas. International gas prices are $16, $17, $18, and dollars per MCF, and U.S. they're like $3.20. So the U.S. molecule is an 80% discount to the international molecule. Yes, gas supply is still growing faster than we thought because the Permian keeps producing more gas than we originally modeled, but we've remodeled it, and we're still confident that that supply of gas will roll over, just as the Permian oil supply is rolling over right in front of us right now. Gas supply will follow. So, like I said, this trade, everything has gone against us. 3 of the last 4 winters have been abnormally warm. One of the big LNG plants, was offline for an entire year. We lost 2% of global U.S. demand for gas because of that. Everything has gone wrong against this trade, but we still believe we're going to be right on this. And we're talking about it converging. So how about buying an asset class today that's priced at $3.50 that's going to go to basically almost 20? So I think that is that, and the natural gas stocks are being priced at basically $3 to $4 an MCF. So there's going to be huge upside in those areas. So that would be number 2, my second favorite area. And both of them are related to energy and the what's going on in the Straits of Hormuz.
Leigh, always great to have you as our keynote, halftime show. It's because it's like you bring it all, you bring all the pieces of the commodity pie together, and some great takes, right? And
we've documented these takes over time, right?
Totally. And I think that you really there are real out of consensus views that get investors thinking about positioning across the board. Obviously, great to have you for Hard Money. Commodity 101, all whenever, and if you're ever in Toronto for PDAC, we've been trying to get you out. If
these years,
if you ever come through, it'd be great to do this in person. But Leigh, thank you so much. We're gonna watch this all unfold, and obviously some great insights on what could be a very, very volatile year to the upside for energy assets.
Well, Thomas and Scott, I love doing this with you guys. And again, let's do it again real soon, because we'll see whether my last round in December, there were a lot of good predictions there. I lucked out. Hopefully this time I'll luck out again. So
you're a good luck charm, Leigh.
Thank you, Leigh.
All right, great to see you.
Okay, very good, guys. Thank you. Bye.
All right, Hard Money. Don't go anywhere. Train keeps on rolling. We'll be right back after a short break. All right, everyone. Welcome back to Grizzle Hard Money. Now we're joined by Stephen Soock. He's VP of Investor Relations at Heliostar Metals. Stephen, thanks for being with us.
Thanks so much for having me.
So I want to start off on Heliostar. You're one of the most active mid-tier producers and developers in Mexico, which is very interesting. Could you help investors understand why is Mexico such an attractive mining jurisdiction, even with the always fluid security and political environment? It just always is somewhere that miners seem to want to operate.
Yeah, it's a great place to build a business. Mexico has a deep mining culture, lots of skilled labor, lots of mining supplies, mining suppliers, and people are proud to say they're in the mining industry down there. Mining's maybe become a bit of a dirty word in North America to some degree, depending on who you're talking to. But in Mexico, people really are proud of that culture and multi-generational, involvement in it. It's also, from a legislative perspective, a great place. You can get permits, you can build a business. And then from geology standpoint, there's a few other jurisdictions that are as good. It's got silver, it's got gold, it's got copper, it's got a little bit of everything. Now, obviously, we're focused on the gold side, but there's multiple gold belts throughout the country, and somewhere where there's lots of opportunity from that way. So, we found that the ability to pick up underloved assets and turn them into something more than the previous owners thought they were. It's been a great jurisdiction to be able to build that business in that way.
Yeah, it's a unique
Great.
angle.
So, yeah, do you want to give us a brief overview of the Heliostar's producing and development assets, just kind of the big picture?
Yeah, absolutely. So we're scaling up to be a 300,000 ounce a year producer from the 50,000 plus ounces that we're on track to produce this year. We're able to do that through executing through our growth pipeline of development projects that we own 100% of and fully control our ability to move forward on. So we've got kind of a growth mindset at our core, and all that's supported by our two cash flowing mines, and that's really what makes us unique. We're able to show a developer like growth trajectory without the usual equity dilution that comes along with that. We're using kind of a bootstrapping methodology to take small scale production and cash flow, leverage it into more sizable production and more meaningful cash flow, and so on and so forth to be able to bring our Ana Paula flagship development mine online. That's going to be a major cash flow generator once we've got that up and running in the second half of 2028, and really going to be the cash engine that fuels all future growth for Heliostar. So just give a few more details on each of those. We bought two producing mines and a pipeline of assets. Like I said, we're unloved by the previous operator. We bought them for $15 million, and we've since made more than $70 million in operating cash flow from them. Both mines were on shutdown or care and maintenance. We put both of those back into production and had found a lot more meat on the bone as we harvest those assets for cash to be able to fund Ana Paula.
Excellent. That was a good overview. So I noticed you recently branched out geographically. You acquired the Goldstrike project in Utah. Are you looking to diversify? Is that where there's just an asset where it looked too good? You really just wanted to see what you could do with it? Walk us through the rationale of acquiring that project.
We're a technically driven team, so we always look at the asset first. We want to find assets where we think there's more upside, where we think there's optimization opportunity, and that's really where we start from an evaluation standpoint. The Goldstrike acquisition was something we found just through industry connection. It was sitting on a shelf, kind of hiding in plain sight under Liberty Gold. They were focused on advancing their second project. So we were able to pull it out of them, which we thought was at a really good price to get a million ounces of gold in the Great Basin in Utah, paying just $75 an ounce with lots of geologic upside there. And we love Mexico. We're always going to operate from Mexico as a base for us. But at a certain scale of the company, it behooves you to start to geographically diversify. And the market certainly seemed to like that aspect of the acquisition as well. So we're always hunting in Mexico. We're also hunting outside of Mexico for additional M&A opportunities. It really starts with the project, and we'll find more good projects or more good mines, operating mines to bring into the portfolio as we continue to grow.
Great. So you guys have a really good slide in your deck that looks at the production potential of the assets producing now and the ones that are going to come. So it looks like it's a pretty aggressive production pathway, pretty attractive. I'm just curious, what are the key assumptions that would you say are embedded in that outlook if you're going to hit what the charts are showing?
Yeah, sure. So the way we're executing is as a series of staged projects right now. We've sequenced those projects to maximize near-term cash flow, minimize near-term capex requirements to be able to build that cash really to bring Ana Paula online. So one of the key assumptions is the timeline to build Ana Paula. We put out a PEA study, a preliminary economic study late last year showing we'd be able to do 100,000 ounces a year over a 9-year mine life at a $1,000 per ounce all-in sustaining cost because of the rare combination of grade and thickness that is Ana Paula. That's a unicorn sort of setup in the industry. So bringing Ana Paula online is a key assumption. It was previously permitted for an old open pit project the way it was envisioned by the previous group. We're modifying that to go underground. So being able to keep that on track. We're also doing the technical work in the background to be able to advance that more advanced full feasibility study that'll be out in late Q2 next year. And then working on the financing discussions as well. We're going to pair about 150 million of internally generated equity to fund our half of Annapola alongside about 150 million of a project finance facility. So those pieces have to come together. Everything's tracking right now, but it takes time to do the technical work, to have the due diligence discussions and process happen, and then all culminate in a construction decision in late Q2 next year. The last piece of that, to get to that 300,000 ounces that we're able to show by the end of 2030, is bringing our Cerrado project online. This is another open pit heap leach project that we acquired as part of that portfolio early on in our genesis as a company. We put out a pre-feasibility study late last year showing kind of where some of the gaps are. We're going to kind of do the work to fill in where there's a few deficiencies and be able to rescope the project bigger, because we found there's a lot more there that wasn't captured. So as we go through that process, that'll be the asset that follows Annapola and, like I said, bring us up to that 300,000 ounce a year run rate by the end of the decade.
Thank you. That was helpful.
Great. Now,
Yeah.
could you talk about the potential you see to extend mine life at your two producing properties?
Yeah, definitely. So La Colorada, our one producing mine, has got a 6-year mine life on the books right now on reserves. But we think there's a lot more there. We did more drilling in 6 months than the previous operator did in 5 years. So we've since poked around a little bit and already been able to find areas that we're going to expand on. Two of those that are immediate opportunities is a larger pit at Veta Madre called Veta Madre Plus. We're just doing the engineering now that should encompass an additional 10 to 15,000 ounces. And then the drilling program also show that there's high grade mineralization that continues under all the pits. So we think there's an eventual, high grade underground feature at La Colorada as well. Again, we need a little bit of time to really do the drilling, tackle what the scale of that opportunity is and where it fits in our production profile, but it's there nonetheless. Beyond that, there's the whole rest of the land package, which is seeing maybe 15 drill holes. So we're going to start doing a little bit more exploration further afield. There's a past producing open pit called Los Dundes that we're going to run a resource expansion drill program on starting later this year. And then a bunch of, geochemical anomalies, soil sampling anomalies, other small scale workings that some of which have never seen a drill hole. And we're going to start to rectify that starting later this year. So we think we'll be mining there for more than a decade by the time it's all said and done, well past the 6 years we have on the books. And then San Augustine, think of this as a short-term cash flow ATM for us in a way. It's got 14 months of mine life on the books. Over that 14 months, we'll generate about $60 million of net free cash flow. Beyond that, we've now done drilling stepping out 200 meters from the edge of the reserve pit, showing the exact same style of mineralization that we're profitably mining right now. So, internally, we think we've already added another 9 to 12 months of mine life, which would, at spot prices, represent about another $50 million of cash flow. So, again, it takes time for all this to work through the technical process, but we think there's a lot more meat on the bone at both of those assets, well beyond what's just shown on our reserves.
Thanks. That was very helpful. I just want to move back to Annapola for a minute here. What would you say are the remaining steps you need to hit to bring that online? And as you look at funding the CapEx for both Annapola and Cerro del Gallo, how are you thinking of what your options are there?
So as I kind of touched on a little bit, we need to get the financing lined up, and that's something we're starting discussions now. Everything from your traditional bank debt, right down through kind of a Nordic bond structure, something a little bit more flexible, and then also looking at the more traditional high quality private equity funding packages. Also, a few off the wall ideas, like let's call them non-traditional capital providers into a gold prepay structure. Everything's under evaluation right now. We're really looking at it through the lens of cost of capital, obviously, and then the flexibility that these options allow us to. We are a growth company. We're going to continue to grow. We don't want to be handcuffed for years, paying back debt. We want to continue to be active and continue to grow our production profile. So that's a major piece that we're currently working on. The technical review, it takes a lot of hard work in the background to make sure you've got all the technical work done to build a mine the right way, and all that's All that's ongoing right now. That will culminate in the feasibility study out late Q2 next year. But in the meantime, we'll probably give investors an update just on how all that's been going, that they don't get a peek into that often. And then the permitting piece, we're going to submit the permit modification in August this year. It's supposed to take 6 months to turn around to us. Knowing Mexico, we've allocated 10 months. And it was permitted for an old open pit project. We're asking for about a third of the disturbance that's already been permitted once. So we don't think there's going to be any issues working that through the bureaucratic process to get approval there. Those are kind of the major pieces to get us to a construction decision. Then all we have to do is build a mine, 15 to 18 months of construction timeline, and then ramping up from there. But we're really motivated to keep Ana Paula on track because it's something special in terms of its cash flow potential. The PEA showed that $1,000 per ounce all-in sustaining cost for 100,000 ounces a year, and that's because it's that rare combination of high grades over wide widths. Your traditional high-grade underground mine is very narrow, takes a lot of development, is operationally complex. Ana Paula is not that. It's a big blob of high-grade mineralization. It's fairly easy mining. You get economies of scale from the bulk tonnage mining you're able to execute. You get a high margin from the high-grade material that you're pulling out of the mine and processing, and that culminates in just an incredible cash flow profile. We think we'll be able to generate about $200 million of after-tax free cash flow annually from Ana Paula alone, let alone from all our other producing mines that'll be online thereafter. So I think looking at Heliostar as a value proposition there, we're trading at just over 2 times annual cash flow from Ana Paula. In the mining sector, that multiple is usually between 6 and 8. So as we do the work to de-risk that mine into production, you should see that gap close.
That's a great way to think about it.
Great. And just and final question, just key catalysts over the coming 12 to 18 months.
We've got a lot going on. We'll be drill bit heavy over the next little while. Mine life extension drilling at San Augustine, down dip drilling at Ana Paula, showing that high grade system does continue at depth, and there's potential for a tier 1 multi-million ounce deposit sitting underneath the mine we're going to build, and then regional exploration at La Coloradas. Then in the second half of the year, we move more into an execution phase, doing waste stripping at our Beta Madre pit that'll unlock ore production for 2027, showing that progress on the feasibility study at Ana Paula to the market. And then the third layer of news flow is really just that blocking and tackling that shows that our strategy is working. Those quarter in, quarter out results that show we're building cash on the balance sheet while we're still reinvesting in both exploration and growth opportunities within the portfolio and generating some solid earnings along the way. So all things for investors to look for, across multiple avenues of news flow over the next 6 to 12 months.
Really interesting story, Stephen. Thanks for joining us. That was Stephen Soock. He's VP of Investor Relations at Heliostar. Thanks for being with us.
Thanks for having me.
All right, guys, Grizzle Hard Money. We're just getting warmed up. We'll be right back after a quick break. Don't go anywhere. All right, everyone, welcome back to Hard Money. Our next guest is Steve Cope. He's CEO of Silver VIPR Minerals. Steve, thanks for being on Hard Money.
No, it's good to be on, guys. We always enjoy it.
Oh, always great to catch up.
Now, Steve, could you just walk us through the long-term strategy for Silver VIPR? I mean, you have a successful history of using exploration to build valuable resource packages that large miners really want. So say you do it again with Silver VIPR, what do you think is the resource number you need to hit to make majors or mid-tier miners take notice? What's your strategy for this asset this time?
Yeah, I mean, any asset that we look at, when we're speaking with the major miners, if it's on the gold side, they're looking for 2 million ounces plus of gold in the resource. On the silver side, and Fresnillo is a great example, they're looking for 200 million silver equivalent. That's our all. Like, any project we look at, we want to see that potential to be able to grow it to that size. If you're talking about the mid tiers, obviously the number comes down, and I mean that can be as low as like 500,000 ounces of gold or 50 million silver. I mean, that's in their wheelhouse to start mining. It just depends on size and scale. But like I said, our focus is on, what the big boys are interested in, and we won't continue to work an asset if we don't see that type of potential.
Okay, that's really helpful. So you guys are fully funded for a pretty large drill program. Could you just walk us through the meters you have planned, how much you've done so far in, say, the past year, and the timing of when you think you're going to get through these programs?
Yeah, so we started drilling end of October of last year. We budgeted for 30,000 meters at La Virginia with that program. We're about 10,000 meters in right now. We'll be ramping the program up here moving forward as well. So it's, we're on pace. We're going to be still targeting a resource update with that drilling, in Q3. But we're going through the meterage quick, and it's been going well. Drilling's been successful. So we're going to continue to move along with the program.
Do you think with how long it takes to get assays back and everything, can you get through that program this year, or is it going to bleed into next year, you think?
If we add a second rig, we could definitely get through the program this year. We'll see how it's all going, whether it bleeds in or doesn't bleed in. But I know we definitely have the ability to get through that whole program.
Okay, great. So the deep target below El Ruby sounds like one of the highest impact exploration catalysts on the horizon for you guys. Could you just tell us more about the geological evidence that gave you the initial confidence to drill this target? And most importantly, when should we expect first drill results from that test?
Yeah, so that drilling's coming up very quickly. We're really excited about testing El Ruby at depth. It should be coming here in the next couple holes where we start that exploration. I think the assay lab turnaround time so far has been about 2 months. So we drill that coming up in the coming weeks. We're probably looking at 2 months. I can't speak to what happens when the Golden Triangle really fires up and goes full bore, because the labs slowly, as it spreads out from BC, and our multi-elements traditionally are run in Vancouver, it can bog down the lab a little bit, but we also can source other areas or other spots to send our materials to. I know our lab now has an option to send it to Peru, which I don't think anyone from the Golden Triangle is sending their multi-elements down to Peru. So I think we can avoid the bog down a little bit. But yeah, that's coming right now. As far as the evidence of why we're drilling that, so we had Quinton Henning and Crescat Capital did their investment in us, and he did a deep dive into our database. And so part of their investment was doing a magnetotelluric geophysics program, which is it's a deep penetrating. It shows you kind of what's happening a lot further down below the surface. And so we did that geophysics program. It lit up a very large target below our El Ruby area, kind of what we're looking for. But the kind of thesis behind it is we have, a host rock that's in the andesites. It's a great rock for mineralization. It's brittle. It allows for big blowouts mineralization. Below that, you have a very tight, dense rock in the rhyolite package as a host rock. So it's still mineralized, but you don't get the same grades and widths that we see up in the andesite package. But because of that, when those fluids came up to mineralize the system and they hit that bottom of the rhyolite package along that contact, you should have this large blowout of mineralization. In his hypothesis, that would be like a meta sediment or a limey sediment package. So when he said it, he goes, "You're onto a large gold carbonate base metal system." And so far we have no carbonates and we have very little base metals, but that's what'll happen at that contact. But even if it's not a limey sediment package and you have a big blowout of sulfide mineralization down there, polymetallic, you're still going to see something. And if it's there, and it should be, it's just a question of where is it exactly. We think the geophysics is vectoring us in on that. And then we also, the other evidence, sometimes every so often in our assays and our core up in that andesite package, we'll get a 0.5 meter sample where we see some of that sulfide mineralization that's been blasted from depth into a 0.5 meter. And in that 0.5 meter, we'll get, the high grade base metals number along with our high grade gold, silver, but a 0.5 meter on either side of that, where you don't have that chunky sulfide mineralization that came up. You're still in high grade gold and silver. There's just barely anomalous base metals. So we know something is there at depth that's vectoring in on it and finding it. And if we do, you're talking about the potential for, a multi-million ounce gold silver deposit in itself, just down at depth, never mind, the potential we already have at surface.
Got it. And we'll know soon on that anyway.
Well, certainly. I hope, fingers crossed. This was
yeah, fingers crossed. So moving on to Fresnillo, they're your largest shareholder, and you guys said recently they've opened their portfolio of assets to you. How should investors think about the strategic value of that relationship, and what optionality does it give you guys?
Yeah, so I mean, it's something we've had a relationship with Fresnillo for a very long time, through other vehicles, and they've always respected the level of work that we do. Now that deal is finally closed for the Kinetto asset, they've got 15 to 16 other projects in their portfolio that aren't sitting at that 200 million silver equivalent threshold right now, and they're finally, after a long time, looking to open up that portfolio and bring in partners. And now that they've got a large holding in us and are well positioned, they've talked about wanting to increase that ownership. And their preferred method of choice would be to do another acquisition. So our geology team is diving in right now. They're starting to look at that portfolio, see if anything makes sense for us or something that we want to jump on or move forward on. But for us, we want to see on those types of assets, we're looking at something probably the same size or bigger than what we did at Cerrado with an existing resource, able to acquire the ounces, at a rate, at a price that we're happy with, and in one of those jurisdictions that we're happy with. We're not just going to, acquire any asset. We're really happy with the state of Sonora and the state of Durango. There might be a couple of the surrounding states that we would look at, but we're pretty picky on jurisdiction, and so we wanted to have synergies with other projects and that we have in the company already.
Great. That's helpful. Now I want to talk about Cerrado. It sits at around 50 million silver equivalent ounces. Well, Fresnillo appears to focus its capital and project. You said that 200 million silver equivalent or higher. Which veins or target areas have the best chance of driving you towards that 200 million ounce number, based on what you know now?
Yeah, so there's six veins currently in the resource out of 40 that are kind of known on the project. And when I'm talking about the 40 known, basically what you see on that is there's old workings that are kind of 80 to 100 years old. There's probably been some sampling across them in the database, but they've never been drill tested. So we have room to expand on those existing 6 known veins. And my favorite of those veins, or my favorite vein, I guess, is 2 veins. The La Bufa and the Santo Nino vein are kind of parallel, and you can drill through both in one hole. And there's a lot of spectacular hits in that Santo Nino area. And that vein happens to be polymetallic as well. And there's been no base metals included in the in the resource on that project. So that vein in particular, I think we can hit some pretty spectacular stuff. There's a lot of intercepts in that area that are outside of the resource. So going back in, we can add ounces quickly at that vein because there's a lot of intercepts that are too spread out or been drilled since 2021 when the last resource was done on the project. So we'll have one rig focused there, and the other rig will be focused on making new discoveries on those other kind of 33 veins, and our geology team's kind of working in there now. They're going to be doing some mapping and sampling and kind of deciding in their minds which of those veins are their favorite targets. But there's a lot of good stuff. I remember up to the northwest, there's some old kind of in Mexican ingenuity workings there where they were using like old car engines and different things to like crush their rock and process stuff. But these veins have never been drill tested. So we're going to get up into some of those areas. I think it's going to be pretty easy to make a new discovery because what happened was is the old workings in that they were only able to go down to the water table. So you're talking about they may have mined only like a 20 meter to 50 meter at most, and even that might be too far of vertical extent on these veins. And these veins typically are 300 to 600 meters of vertical extent at least, when you're talking about Mexican epithermal veins. So it should be pretty easy to go back into a lot of these old workings areas, go drill right underneath them, and then start to develop, a new resource on those different vein targets.
Could you just remind me have you guys said publicly how many meters you want to drill this year at the project?
Yeah, I mean the closing the acquisition took a little bit longer, so we'll see how many meters we get in. With 2 rigs, we can go through pretty quick. Right now, we're just waiting to transfer the SEMARNAT permits. I think our initial first phase of drilling on Cerrado, we'd like to see 25 to 30,000 meters of drilling done. Whether that probably goes into next year now at this point, we'll see. But I think over the next 12 months, for sure, we'd like to get 25 to 30,000 meters of drilling done there as kind of an initial program phase. And then based on success, based on new discoveries, we can go and we can start ramping up from there.
Okay, thank you.
So Steve, just, for investors looking at a very high level, just to understand the full strategy of the company, how you think about acquisitions, but also just, maybe you can talk about high level, like the compelling value, arb there is, right? Because that really is, the story for Silver VIPR. You guys understand the rocks, and just a refresher for those new to the story would be very helpful.
Yeah, so we've kind of positioned ourselves to be the largest explorer in Mexico. We're aggressive on the drill front. That's one side of it, but the other side is we want to continue to grow the company with, strategic acquisitions. So we have the bandwidth. We want them to be assets in probably those 2 states. In Mexico, we're going to be a Mexican-focused company, but we're looking definitely at Sonora and Durango. And if there are situations that are presenting themselves where ounces are still cheap, relative to the peer group, and they're strategic, and there's something, whether we know we can get involved and bring a project back to prominence, or know that we can advance an asset fairly comfortably to those bigger numbers, like trying to get them to 200 million silver equivalent plus, like we'll jump on those types of acquisitions and bring them on. And we're definitely evaluating, a lot right now. And because of the success of the company, we've, I think, had a lot more projects and examples, and companies are willing to do a deal with us where, with unproven management groups, they're maybe not necessarily going to go down that path. So I think you can expect to see us to continue to be active on the M&A side, whether it's through Fresnillo or through, some of our other shareholders that have access and a nose on different things that they're excited for us to get involved with. We'll be looking at that. As far as right now, the industry as a whole, the shares of these companies, ours included, with the pullback since kind of January, it's presented an investment opportunity for like that I didn't expect kind of coming into VRIC and what we were seeing in Vancouver. And so we're still so heavily discounted to where the metals prices are at right now across the board. And I'm not just saying Silver VIPR. All the explorers this is a historic time for gold and silver, with producers, printing capital, even with the small pullback in metals prices. And the juniors saw a brief lift, and we were starting to, start to get revalued. But with the pullback now, it's set up another opportunity for investors here.
Yeah.
Just to get us back to the highs that we were at in January. Investors are looking at, a 3 or 4x. And that's just a start. And we're going to see metals continue to move, and we're going to get back, go through this war in Iran, and then you're going to see that lift, and then that's what investors really can look forward to right now.
So and maybe just a question on that, and just for investors like looking at these companies and saying, there's a disconnect, A, with the silver price, B, you have a pullback here, could be regional. Just, maybe you could help me envision a re-rating scenario for A, the industry, and then B, Silver VIPR within that, because that would be really helpful for investors. Because I'm pulling up a screen and I'm seeing exactly the same thing, and I'm like, wait a minute, you can either pick the producers off, and surely at some level the producers are saying, we're still getting the product, we're still getting this Mexican product to market, silver prices are still, at very robust levels. Paint that picture, because I think that'd be helpful, for investors to understand.
Yeah. So one of the things I've looked at historically, and we'll start on, I guess, on the macro side, but is for decades now, people have said, oh, an ounce of silver in the ground is worth $1, it's worth 50 cents, it's worth maybe $2 at most. Like, that's kind of what we've seen for most of my life in this industry. And you talk to the older guard, and that's not the historic case that you've ever had. When you're in good markets, the rule used to be a third, a third, a third. The company being acquired was a third of the metals price. Essentially, a third was cost, and a third was the upside for the company doing the buying. And I think that's what we're trying to, maybe not to that. If we get to that, we're talking about like an absolutely insane market when you're talking about $70-some silver. And if we're getting a third of that as an ounce valuation in the ground, let's talk about $25 silver in the ground. Like, that, I think, would make people think I'm crazy if I said we were going back to that. But let's take a conservative approach to that. Let's start getting $5 an ounce. Let's start getting $6, $7, $8, $10 an ounce, whatever that number is on the silver side. Or on the gold side, forever people ingrained, you're getting $100 an ounce US in the ground, and that was like really good.
Mhm.
And it doesn't make sense now with how quickly gold has moved up, and you're starting to see it finally. And I've said this, what will get people comfortable with new ratings is what the majors, when they're buying the quality assets and what they're paying in a premium as we move forward. And so you've seen it with like Agnico and the Rupert acquisition, where they spent $4 billion on that. That's now you're seeing ounces in the ground that are going for a lot higher than $100 an ounce in the ground, because these companies can see the economics, and it's going to change. And so investors, it'll take time, and that's where a long drawn out macro market for 8, 10, 12 years is going to be great, because people will start to adapt. The quality of projects aren't going to get sold for $1, $100 an ounce in the ground. They're going to go for what actually makes sense to motivate them to sell. And so I think that's, on a macro scale, a huge opportunity for investors here, is that they need to they're too used to something that's been historically one way. And now with this massive move up in metals prices, where we're sustaining these metals moves, I think we're going to continue to move up, and we're going to see new record highs here in the near future as well on metals prices. But we don't need it, because we're already sitting at a point where everything needs a massive re-rating. And again, this is if you think we're valued at $1 an ounce in the ground, like, let's get to 5, let's get to 10. Like, that's the X that exists here that hasn't been valued into our sector at all. Now, on focusing more in on VIPR, I think what we've seen, and one of the reasons we want to run this large program, is the companies that have been the largest explorers in the past in Mexico, or in our case in Mexico, have commanded a premium to their peer group. Being able to get that level of information in a time frame a lot quicker than, the rest of the peer group that might be drilling 5,000 meters a year. We're getting that same level of information that they're going to get over 10 years, and we're going to do it in like a year and a half. So
Right.
that was, resonates with the fund managers. They want to see companies that are able to progress these assets and get them to build decisions, get them to production decisions, as quick as possible. And so I think in that sense, we're going to have a lot more news flow. We're going to have a lot more catalysts. We're going to make more new discoveries. And because of that, you're going to see our share price trade at a higher premium to our peer group initially. And so if people want news and they want catalysts in the companies they're investing in, I think Silver VIPR is definitely the place to do that, because we're going to have multiple resource updates, just on Kinetto and La Virginia, never mind any new acquisitions as we progress on anything else. You're going to have assays coming out steadily moving forward all the way through the year, and then really ramped up once we start the program on Kinetto. And then, like I said, new discovery. So you're going to get a lot of catalysts. You're going to get a lot of information. It's something now that is pulled back like everyone else dramatically, and it's a great entry point for a lot of investors.
Yeah, you really frame it up really well in terms of at least what you're playing for with respect to an investor looking at Silver VIPR. Is it you're clearly identifying that you'll have to be at the top pole position, right, for drilling, and you've seen that play out in the past, right, that there's value to somebody with a lot of inventory, the top inventory. Is that, if I'm understanding that correctly, in any
Absolutely.
particular region?
No, for sure.
Well, that was great. That was
catalyst.
Oh yeah. So you mentioned individual catalysts. Can you just kind of round it out for everyone? What are the individual pieces we should watch?
Yeah, so the first step, assays, and obviously our drilling is split between resource expansion drilling. So those assays in themselves are great because they're going to show people, new numbers that are going to say, oh yeah, the resource is going to grow. Look at this grade. Look how they're expanding here. The other side of that, though, that is probably an even bigger catalyst normally on the drilling side, is new discoveries. So our drilling is split between resource expansion drilling and new discovery drilling. Obviously, the deeper drilling on El Ruby being covered the nearest term of as far as new discovery potential, but we've got a lot of other targets on La Virginia as well that we're going to be testing and moving forward to bring in as new discoveries on the project if they hit. Same thing on the Kinetto side, obviously, with those 33 veins that have never been drill tested. You're going to have lots of discovery potential. So any new discovery tends to move the needle dramatically for exploration companies. Then the next, obviously, side of the catalyst is the resource updates. And we're targeting hopefully a resource update here by the end of Q3, or certainly cutting off the drilling on La Virginia for the purposes of the resource. And so that, again, both resources on Kinetto and La Virginia were done in 2021 using $1,500 gold and $20 silver. Again, obviously using today's metal prices, you might lower the grade a bit, but an independent's going to look at it and say there's a whole lot more material that's economic that you're going to bring in ounces. Plus the fact that we've already expanded La Virginia by an additional 300 meters to the south. The new drilling, we're expanding it to the north now as well. So you're going to have a lot of new ounces. I don't know what the ounce number is going to be, but I think it's going to be a lot higher than the 700,000 gold equivalent ounces or 50 million silver equivalent that we're sitting at there now. And then the same on the Kinetto side. We're going to be drilling there. You're going to have that catalyst with the resource. Any new discoveries, we're going to step in and systematically explore very quickly to bring them into a resource, expanding on the 6 veins that are already in the resource. And then, I haven't signed any documents yet, but I think, again, there's going to be the acquisition side and bringing on ounces cheap and being able to advance assets and bring them back to prominence on some other things. And that's obviously huge. You're changing your reserves and resources as far as the amount of metal you have on the books when you're talking about valuing ounces in the ground. And so building a big portfolio and growing that ounce number changes your profile and also will command a premium. So stay tuned because there's going to be a lot on the horizon over the next 12 months.
The calm before the storm for Silver VIPR. It sounds like you guys are going to be busy the rest of the year.
Steve,
Absolutely.
thank you. An absolute pleasure, and we'll obviously we'll be watching closely, and thank you for joining Hard Money.
It's always a pleasure, guys. Thanks.
Thank you.
All right, that was Steve Cope, CEO of Silver VIPR Minerals. We'll be right back. Don't go anywhere. All right, everyone, welcome back to Grizzle Hard Money. We're joined by Luke Alexander. He's CEO of Newcore Gold. Luke, thanks for being with us.
Thank you.
Thanks a lot for having me.
So, Luke, I want to kick it off with kind of a high-level question. So why is now the right time for mining investors to look at assets outside of Canada and other developed market jurisdictions where, people know those areas well, but why is it now time to start going a little further afield?
Yeah, so for Newcore Gold specifically, we're advancing the Enchi project in Ghana. It's a district-scale exploration project that's fundamentally underpinned by very robust economics. But then in Ghana, we've got a very supportive government who wants to see projects push forward and built. If you look at our Enchi project, it's one of the 2 most developed projects in the entire country. We're now in the process of taking it from a PEA to a PFS, and we ultimately think we'll be able to fast that towards production. So I wouldn't say every jurisdiction is the same. And even within West Africa, Ghana stands out as a tier 1 jurisdiction to be ultimately investing in. If you also look at Ghana specifically, you've currently got 4 of the top 10 largest gold producers on the planet with significant operations in the country. You've got Newmont, who's advancing their Ahafo project. It currently sits as their 2nd largest gold producing asset globally. So for the largest gold company on the planet to have 15% of their total gold production and their 2nd largest producing asset globally in Ghana, I think speaks for itself. If you then look at our institutional ownership, these are investors who can invest in any jurisdiction on the planet. We currently sit at about 60% institutionally owned. So Ghana, I can speak to as a tier 1 jurisdiction to ultimately be investing in, and for us to be looking to put a gold asset into production.
Luke, maybe just a follow on Ghana, like in how investors should think about emerging markets, especially when it comes to mining. Are there marks that you think that that show the evolution, that property rights and all the rest, that what are the hallmark signs that or you can even compare and contrast a region that doesn't work or a similar region? That'd be it'd be useful to think about it through that lens.
Yeah, so when you look at Ghana, it's called the Gold Coast for a reason. I mean, it's had production coming out of the country for 1,000 years. With that, you've got a very well-established industry that's ultimately been built over, hundreds of years. With that, there's been a very well-established rule of law in country. There's a very well-established mining code in country. From an industry perspective, we've got the Chamber of Mines in Ghana, which is a very strong advocacy group. We've then got the Minerals Commission, who again want to see projects built and pushed forward. In the country, we've got a couple of mining universities and extremely well-trained individuals. From a security perspective, when I'm in country, I don't have any security. We just drive around the country the same way we would in Canada. So all of those things, I think, again, are one of the reasons we have Newmont and Goldfields and Anglo and Zijin, who's come in and bought a major asset in country, Shandong. I think those all contribute to the reason why those companies see Ghana as a tier 1 jurisdiction, and that for us at Newcore, we're very fortunate to have a project that we're now taking through that development stage.
Fantastic.
Excellent. So, Luke, could you just give us a brief overview of your flagship asset and where do you currently sit in the development process?
Yeah, so in Ghana, we've got 2 prolific gold belts. Ghana is the 6th largest gold producer globally, just behind Canada and the US. Our project sits on the Sefwi Bibiani belt. We've got a number of very large mines and deposits along trend from us, including Cerrado sitting at 5.5 million ounces, Bibiani at 6.5, that Newmont Ahafo project sitting at 20 million ounces and growing. We put out a updated mineral resource estimate on our project in March of this year. It outlined 1.5 million ounces of indicated plus an additional 600,000 ounces of inferred. So if you add those 2 together, 2.1 million ounces of global. One of the important things to highlight is that when you look at the pits that constrain that 2.1 million ounces, they're only down to 85 meters. So we've really still just defined a relatively shallow resource on our project. It does remain open along strike, so continuing to grow it along surface, but then importantly at depth as well, there's an opportunity for us to grow the number of ounces on our project. We've then identified roughly another dozen targets across the project for us to ultimately go after. year. So exploration is one of the big focuses for us, and we see an opportunity to meaningfully grow the number of ounces at our Enchi project. But then beyond that, next month in June, or I guess this month at this point, we will be putting out a PFS on the project, and that we see as a major catalyst for the company and a big de-risking phase, which will then ultimately allow us to continue to fast track this project towards production. So district scale exploration with a development path that's very well defined that we think will create a lot of value for shareholders.
Excellent. Yes, you answered a bit of my next question, but I still want to hit on this because I think it's important. So you released an updated mineral resource estimate recently, and you saw a solid increase in total resource. You're over 2.1 million ounces now, but you also have a drill program that's been ongoing. You're more than 50% through. So should we look for another bump in resource with upcoming PFS? Like, how much of that drill program do you think is going to be included in the PFS?
So the simple answer is no. We won't have additional meters going into our PFS.
Okay.
We cut that off. And if you look at our total 60,000 meter drill program, we've released to date about 39,000 meters of drilling. The first 28,000 meters was focused on resource conversion, moving ounces from the inferred to the indicated category. That led to our 1.5 million ounces of indicated. That was ultimately our goal. That's what's being used for our PFS. So all of the additional drilling, so the additional 10,000 meters that we've reported to date, as well as an additional 21,000 meters that we will complete as part of this 60,000 meter drill program, will all go into future resource updates, feasibility studies. So we see that as well as a major catalyst in terms of being able to continue to add ounces on our project, which will then continue to strengthen future studies that we put out on the project.
Excellent. That's helpful. Now, so you just completed another successful raise. What would you say with the money that you're going to have? What can you get accomplished with your current cash balance? What do you plan on doing with the money?
Yeah, so last week we closed a $15 million financing. That was led by very deep-pocketed, long-term focused, mainly precious metals and mining institutional investors. So we've grown our institutional ownership beyond the 55% that we were already sitting at. That cash is going to be used to expand our drill program well beyond 60,000 meters.
Okay.
We're also starting to look past the PFS, which we're going to have out later this month, and we're starting to look at some of the work that's going to be required to get our full feasibility study completed. That's going to include additional drilling on the project, additional metallurgical test work, geotech work, hydrological work. So we're compiling all of that, and some of that cash that we've just raised will be used to ultimately fund the full feasibility work that's going to get completed.
Great. Now, you have a great slide in your deck that looks at the exploration potential that's still at the project. Could you just talk us through the remaining exploration potential and the timing you see around when you plan to drill your most prospective targets?
Yeah, so when you look at our resource today, as we talked about, a global indicated plus inferred of 2.1 million ounces, that comes from 4 deposits on our project. We've identified about 25 targets across our entire project. Coming through our project, we've got about 100 kilometers of shearing. Our neighbors along trend sit at 5 million ounces plus. So these are a number of the things that we point to when we talk about district scale exploration. So we've got a lot of value that we can still unlock through the drill bit and through exploration, focusing in on our existing resource areas, which still remain some of our most prospective areas, given how shallow the drilling to date has been, as well as the fact that they remain open along strike. That's going to remain a focus. So stepping out along strike, continuing to target some of these high grade structures that we've identified across the project will remain a focus. We've then got previously drill tested areas. These are areas where maybe historically we've drilled 2,000 to 5,000 meters, and we want to get back in there, do additional drilling, grow the mineralized footprint, and over time bring those into our global resource. So that's another focus for us. We're then doing a lot of early stage work at the other dozen plus targets that we've got on our project, soil sampling, trenching, that type of work to determine which one of those call it greenfield targets on our project might warrant us putting some initial holes into them. So we move all of that forward at the same time, and really it becomes result based. We've got 4 drill rigs turning at the moment, and as we get assays back, we're constantly reprioritizing where we move the rig and what targets we focus in on that we think will ultimately create the most value for shareholders. So that's the approach we take. But at the moment, we've got 3 diamond rigs turning, 1 RC rig. The RC rig is focused on that kind of shallow near surface growth opportunity we've got. But then we're extremely excited about the opportunity at depth. And if you go to our presentation, you'll see a number of these high grade feeder zones that we've identified on our project. And with those diamond rigs, we're targeting some of those at the moment. And if you look at the results we've put out so far in 2026, you'll see we've had some of the highest grade intercepts ever on our project, which continues to support our geological thesis, which is as we hone in on these high grade feeder zones, there's going to be an opportunity for us to continue to bring in higher grade material, as well as everything else that we've identified across the project today.
Excellent. Sounds like you have a pretty sophisticated exploration strategy. So thanks for taking us behind the curtain a little bit to better understand that. That was helpful. All right, Luke, I just wanted to end things off by going through your key milestones. You have a lot going on. You're pushing forward quickly. What should investors focus on over the next 12 to 18 months as important catalysts, things you're looking forward to?
Yeah, so as we've kind of talked about a little bit, we've got our PFS coming out this month. We see that as a major de-risking and catalyst for the company. We're then obviously in the midst of a 60,000 meter drill program. We've so far only released and completed 39,000 meters of drilling. So we've got an additional 21,000 meters of results that will come out over the next number of months. We've then also, as we talked about, raised $15 million last week. So we will look to take that money and expand our drill program well beyond 60,000 meters. And then on the back of the PFS, we'll lay out a plan to start to complete that full feasibility work that we talked about a little bit as well. So PFS, major catalyst this month, lots of additional drill results. I mean, we could wake up tomorrow morning and find out that we've hit another big high grade intercept, which could be a big catalyst for the company. So lots of drill results from that perspective. And then we're going to start looking forward to the full feasibility work that needs to get completed. And we'll start to lay that out as well. So lots on the horizon from a news flow perspective, and ultimately major catalysts that can create value for shareholders.
Excellent. Well, everyone, you heard it from Luke Alexander, CEO of Newcore Gold. Luke, thanks for being with us.
Yeah, thanks a lot for having me.
Luke, thank you.